system auditor and is also a partner of Prasad and Prasad Chartered Accountants Hyderabad since 1986. He is the past chairman of Hyderabad branch of SRC of ICI, also the past president of the AP Tax Bar Association and International Fiscal Association Hyderabad subchapter. He was the chairman of All India Federation of Tax Practitioners South Zone for the term 2010-11. He co-authored a book titled International Taxation, a Basic Study, published by Book Corporation, Calcutta. He was appointed as one of the branch reporters for IFA Congress 2010 that was held in Rome, Italy, on the subject tax treaties and tax avoidance, application of anti-avoidance provisions. He was co-opted member of the Committee of International Taxation of ICA for the years 2016-17 and 18-19. He was invited to speak at IFA Asia-Africa Conference held in Mauritius in May 2012, May 2014, and 2016. He was also invited as a panelist at Asia Pacific Regional Tax Conference 2016 held in Seoul, South Korea in May 2016. He is a regular faculty for diploma course on the international taxation of ICA, a very regular face across India for all the seminars in direct taxes, and he has also served as vice chairman of IFA branch 2018. I present Mrs. Prasad to the August audience. Thank you.
Thank you, Pankaj sir. Chairman sir, with your permission, now Gaurav Singhal sir also introduction will be now. Is it okay?
Yes, we introduce the sir.
Yeah, thank you, sir. Welcome Gaurav Singhal sir once again. I request Vice Chairman of Hyderabad Branch, C.A. Deepak Ladda, to introduce Gaurav sir, please.
Thank you, Satish sir. It is my pleasure and thank the Chairman of Hyderabad Branch for giving me the opportunity. Am my voice audible? For giving me the opportunity to introduce the learned speaker, C.A. Gaurav Singhal from Delhi. C.A. Gaurav has an experience of around 2 decades, specializing in corporate and international taxation. He has worked for more than 10 years with organizations such as BMR Associates, KPMG, and E&Y. He is a co-founder of a professional services firm and a knowledge enterprise. He is a regular speaker in seminars organized by various firms such as ICAI, IFA, etc. He is frequently invited by law firms, CA firms, and other corporates to train their employees on domestic and international taxation matters. With a brief introduction, thank you for giving me the opportunity. Over to Secretary, sir.
Thank you, Deepak ji. Chairman, sir, should we start the proceedings now?
Yes, sir. For the information of the entire delegates and learned speakers, for this 3 days program, more than 410 people has registered so far, and this is the charm of PVS's Prasad, sir. Welcome to you, sir. Over to you, Prasad, sir.
Before Prasad sir speaks, one or two.
Shall I start, Chairman? Yes, Pankaj, you are telling something.
Sorry.
One request to all the members is please don't keep giving your name, membership number in the chat box. It is disturbing the speakers because when he's speaking, suddenly something pops up. So request all of you to just avoid doing that. If you want, there will be a small gap afterwards at the end, you can put it. Any of the Zoom software is giving the attendance. Each person, from seconds, how much he or she has attended, the software gives attendance, and based on that only CPE hours are given. So request all of you to avoid and enjoy the learnings given by Prasad sir and Gaurav sir. Thank you. And all the questions, please put it in Q&A. Don't put questions in chat or membership numbers in Q&A. Only questions from Q&A will be considered. Thank you, sir.
Thank you. Pankaj, you will help me in Q&A when it comes up.
Yeah, I will be reading out for you, sir.
Okay, thank you. So I'll just share screen the presentation. Chairman of the Hyderabad branch, Dynamic Chairman Machar Rao, Vice Chairman Deepak Ladda, Satish Kumar, the other office bearer, past chairman, my beloved friend Pankaj Trivedi, Naresh Gilli, and Mr. Gaurav Singhal, my good friend from Delhi, the co-speaker, who has readily accepted our invitation. We very much thank him for the gesture. And I'm really happy to be part of this program, which has been planned very well by Machar Rao in the COVID time. And in fact, he started working on this program almost a month back, more than a month back. And he has done an excellent job in lining up this program successfully. And in fact, now it's not to overemphasize, but the taxation is always important. And now for every practitioner, there is no way they can ignore this field of law, international tax, because gone were the days when we used to think that international tax is a rocket science, used to be practiced only in places like Mumbai and Delhi, and it may not be required for practitioners in the other parts of the country. But as you have been watching from last 2 decades, more specifically from last 1 decade, the growth of the Indian economy is happening in a very big way. You have outbound investments happening in a very heartening way, in the same path as how inbound investments are happening. And Hyderabad is also a very favorable investment destination center. And there is no way you can sit in the comfort zone and overlook this branch of law, because it has become so compelling now. There is no way we can avoid this, because we know of restaurants or the hotel chains, small hotel chains, like not small, established hotel chains like Saravana Bhavan having their presence in US and other parts of the world, Singapore and all that. And diamond merchants from India have their presence across the world. Now even the startups which are becoming unicorns have their presence obviously outside India in many countries. And that way, the cross-border transactions are happening in a very, very big way. And we need to really gear up ourselves and update our knowledge on a continuous basis. As you all know, you need a lot of reading for international tax. That is, it is not a rocket science, but you need to update on a continuous basis. You must be a regular student. There is no way you can relax even for a day. So that is how one should really have the bonding with this subject. And then definitely for youngsters and even the middle-aged practitioners, one can really venture into this and do it in a very, very, commendable way. That's what I mean to say. This is a great opportunity for the fraternity. Coming to the subject proper, without any loss of time, because I need to cover section 5, section 6 and 9 with respect to business connection 911. So anyhow, we have the structure like this in section 9. We have the other 912 onwards, and royalty, FTS, what you have in 5 and 6, 6 and 7, and also indirect transfers. All this is going to be taken up by my good friend Mr. Shekhar tomorrow. He is going to lead the discussion almost for 3 hours tomorrow. So I am not going to touch upon anything on FTS, royalty, indirect transfers and all that. So I am confining myself to the basic section of 911 business connection, and also the scope of total income for taxation in the hands of non-resident, and also the new changes that have come in section 6, which are really worth discussing and very relevant for our deliberation today. Friends, Hence, section 5 is one important section which we need to bear in mind, which defines the scope of total income of a non-resident. And in fact, the concept of residence is so critical that would decide what is the arena of taxation, what is the scope of taxation for resident but not ordinary resident, and also the non-resident. Confining ourselves to the specific topic of non-resident, section 5 subsection 2 talks about what is the scope of total income of a non-resident. And in fact, when you talk about the scope, you need to bear in mind, as I mentioned, first of all, you must ensure the residential status. And having ensured that a particular taxpayer is a non-resident, then you need to figure out what are the items that are getting covered for taxation in India. Section 5, subsection 2 talks about income that is received or deemed to be received in India, and income that accrues or arises or deemed to accrue or arise in India as items forming part of the scope of total income of the non-resident. Whatever that accrues or arises outside India is not within the scope of non-resident taxation in India. So thereby, you need to critically look at three dimensions in this direction. One is the residential status, and the second is the place of accrual or the receipt of income, because section 5.2 or even in section 5.1 also, the incidence of receipt of a particular income in India has all pervasive approach to encapsulate the same as a taxable income in India. So that way you need to be very, very careful as to what is the receipt, whether it is the receipt of the amount or receipt of income is again a discussion by itself. So be that as it may, we need to ensure that when you plan something as being received in here, you must take all the care and caution and ensure that whether that item becomes taxable or not as per your particular planning. If at all it is not taxable otherwise, but might get taxed on account of unintentional, action of having it received in India, then you may be caught in unawares. So this you must keep it in mind. Section 5 subsection 2 is the most important provision to know the scope of total income of the non-resident. Income received or deemed to be received, I have already explained. Income which accrues or arises or deemed to accrue or arise in India. So accrues or arises in India is something that directly happens in the context of the transactions happening in India. There could be some transactions which might result in a income being received outside India, but still that may be treated as deemed to have accrued or arisen in India. That is what is very important from section 5 to subclause B. And income accruing or arising outside India is not liable for tax in India. That is anyhow, we know very well that what accrues or arises outside India for a non-resident is not to be brought within the four corners of taxation in India. So just to have a small example of non-resident seafarers against which CBDT has given a circular, number 17 2017, non-resident seafarers for services rendered outside India on a foreign-going ship with Indian or the foreign flag and received into an NRE bank account maintained with an Indian bank shall not be included in the total. The non-resident seafarer obviously is of an Indian origin and receiving a transaction being explained here in the circular, being a seafarer, what is being received into a non-resident external account is not to be taxed. That is what has been categorically clarified by CBDT. See, why they have clarified? Because there was a representation before the board because this non-residents would receive directly amounts into that non-NRA account in India, get caught by the clutches of Section 52A on account of the receipt in India. So that is where CBDT clarified that this should not be treated as an income taxable in India. And that is how you need to be extremely careful on two aspects. One is the receipt of income, and the second one is arising or accrual of an income. More so with respect to deemed to accrue and deemed to arise in income. That deeming fiction is what is taken care by Section 9, which we will discuss as we go ahead. The place of formation of the contract or the place where the contract is carried out are some of the criteria that have to be kept in mind while determining the profits, where the profits accrue. When the business comprises buying and selling of goods as a general role where the property and goods passes is very important in loan transaction, I think the decisive factor would be where the money is actually lent, irrespective of where from it came and the actual place for the usage of money. So I'm just giving one case law readily just to understand the concept of this scope of total income. This is a very interesting case where the SSE company was incorporated incorporated under the laws of US and was thus a resident of US. This is the Galileo's case where the SSE had entered into an agreement with various participating members known as participating carrier agreements. It had also entered into a separate agreement known as distribution agreement with the travel agent I. The travel agent I is located in India, and wherein the transaction goes like this for all the bookings that come from the Indian customers, they collect around €3 for each booking. And out of €3, €1 is being paid to this I who is a travel agent in India, maybe a resident here. And the assessing officer held that the SSE's income generated in India was chargeable to tax in India. SSE here is the SSE is the Galileo, which is the resident of USA. And the assessing officer took a view that Galileo USA has a business connection in India, and whatever €3 that are being received are all to be assessed in India is what is proposed by the tax officer. And then the following is one of the questions that arose during the proceedings, whether the SSE has any income chargeable to tax in India under Section 5(2) of the Act, and whether the SSE has any business connection in India. And in fact, it went up to the High Court, and Delhi High Court opined with the Tribunal's decision that 15% attribution of the total revenue generated from the Indian customers is a appropriate attribution for the services for the business carried out by Galileo USA. And in fact, the High Court also endorsed the AO's approach that there is a business connection. Having accepted that there is a business connection, the attribution of 15% is what is decided by the tribunal, which is endorsed by the Honorable High Court. See here, friends, the attribution of profits to the non-resident business connection or PE, which you will learn as per the treaty law, the attribution principles are very, very complex and critical. That is very, very important. But one thing we need to bear in mind is whatever you need to attribute to a non-resident as an item of taxable income here should be in line with the activities carried out in India. You are not supposed to rope in such income which has no linkage or nexus with the activities that are carried out in India. So that's why the attribution should always be supported and backed by the activities carried out by non-resident in India. That is what you need to bear in mind. And then quickly coming to the Sesa Gova's case, SSE company was engaged in the business of mining, production, and export of iron ore, shipping and shipbuilding. And in fact, the SSE paid demurrage charges to non-resident buyers of iron ore as per the terms of the agreement, and demurrage charges paid by the SC to non-resident companies was disallowed by the SC officer on the plea that the SSE company did not deduct tax at source against the payments made to these non-resident buyers. Non-resident buyers who received the demurrage charges. And SS's contention was that whether demurrage paid to non-resident in terms of the income accrued, SSC argued that this is not to be considered as an income accruing or arising in India, and that is what is argued, stating that this has arisen on account of certain delay in delivery and all that. We know the demurrage charges have to be paid to the the parties when the process of the transaction gets delayed from the delivery side, and that way the argument of the SSC has been upheld by the High Court also, stating that these demurrage charges are not to be considered as accruing or arising to non-resident in India in this particular case. So why I'm trying to explain is what accrues or arises in India, what is deemed to accrue or arise in India is the most critical, the most critical factor we need to figure out. That is the most important thing. For our better understanding, let us have this tabular form which will help us understand better in respect of a non-resident income accrued or deemed to be accrued. Hope my voice is clear. No, Machar and Pankaj or Satish, whenever there is any problem with audibility, please let me know. Income accrued or deemed to be accrued and received or deemed to be received in India, obviously it is to be taxed in India in the hands of a non-resident. Income accrued outside India but received or deemed to be received in India would also fall in the four corners of the taxation scope of a non-resident. Income accrued or deemed to be accrued in India but received outside India. See, either receipt or accrual, if it happens in India, that is good enough to bring the amount into taxation. Though it is received outside India, it is deemed to have accrued and arisen in India, so it would get taxed. Income accrued and received outside India from a business controlled in or a profession set up in India. All of us know only this particular type of transaction would get taxed in the hands of resident, but not ordinary resident, but not in the case of a non-resident. That we need to bear in mind. In the case of R&OR, even this particular item would get taxed in India, but not in the case of a non-resident. Then income accrued and received outside India, a business controlled or profession set up outside India. See, income is accrued, received outside India, and controlled. A business is controlled or profession is set up, everything is outside India, obviously, then there is no way you can bring such item to tax. Satish, if there is any audibility issue, please let me know. Okay?
Sure, sir. If it is more little, will be good, sir.
Pardon?
Only one.
Little loudness. Little loudness.
Shall I increase? Shall I increase? Okay. I will increase. So what I mean to say, income accrued and received outside India, a business control or profession set up outside India. So everything is happening outside India. So there is no way you can bring such item to tax in India. Income accrued and received outside India in the previous year, that is accrued and received both happened outside India. Though it is received in India at a later point of time, it's not going to be taxed. That means remitted into India. This is where you need to distinguish receipt of income versus a receipt of amount. So here in this particular sixth item, the receipt of income is happening abroad. Then you are transferring that amount into Indian account, which is only a receipt of amount and not receipt of income. This has been explained by the Agra bench of the tribunal in the, I think that is Chauhan's case, which is decided by the Honorable Vice President of the Tribunal, Mr. Pramod Kumar. So this is where you need to distinguish and figure out whether it is receipt of income or receipt of fund. a receipt of income or receipt of amount. That is what you need to bear in mind. And then coming to the seventh item, income accrued and received outside India in any year preceding the previous year and later on remitted. This relates to a past year and received now, even that would not be brought to tax on the same principle. Then let us have a quick illustration for us to have a better understanding about the scope of total income so that you become more comfortable, and then we'll get going with the other issues for our discussion today. And then in the case of a non-resident, Mr. Ram, these are the following amounts we need to decide which amount is liable for tax in India, which is not liable for tax in India. So salary received in India from a former employer of UK, former employer, not the current employer. That is what you need to bear in mind. Income from tea business in Nepal being controlled from India, 10,000 rupees. Interest on company deposit in Canada. There is a deposit. This Ram has got economic interests across the world, and he has got some deposits in Canada. And 1/3 of such interest is received in India, unfortunately. So, fortunately or unfortunately, that is received in India, then we need to examine whether it's taxable or not. Then profit from a business in Mumbai, controlled from UK. Okay. Then what are the other items? Profit for the year 2002-03 from a business in Tokyo. That means long back, almost 20 years, 19 years back. He has carried out some business in Tokyo, Japan, and that profit is being remitted into India now. And income from a property in India, but received in USA. Property is situated in India. Always you remember the taxation of immovable property is based on the situs of the property. Okay. And then income from a property in London, property is located in London, but received in Delhi. The income is received in Delhi. Income from a property in London, but received in Canada, no problem. And income from business in Zambia, but controlled from Turkey, not controlled from India. So against these items, let us quickly look at how we compute the total income. Salary received in India from a former employer of UK. It is not the current employer. There is no employer-employee relationship now. So we cannot categorize this item under salaries right now. So the salaries received into India, definitely section 5(2)(a) can capture this as an item of tax, as a taxable item. So we need to bring it to tax in India. And from a tea business in Nepal, the business is happening in Nepal, but controlled from India. But this is the case of a non-resident. Though it is controlled from India, it should not be brought to tax as per the old rules. When we go into the amendments, we need to see how what happens, because there is an amendment and whether that amendment will have a bearing and all that we'll discuss. Interest on company deposit in Canada. So 1/3 is received in India. Once it is received in India, 5(2)(a) comes into picture and it has to be brought to tax. So that is the reason you should never receive the income directly into India. You should receive only the amount after it lands in some other account abroad. That is what you need to bear in mind. If at all there is an income earned outside India, it must first land in a overseas bank account. Then you transfer it to India. Then it could be treated as receipt of amount and not receipt of income. That you must be very careful. And profits from a business in Mumbai control. And once the business is in India, it automatically accrues or arises in India. There's no doubt about it. So though it is controlled from UK, it has more relevance. It has to be taxed in India. And then profit from a business in Tokyo remitted to India. As I told you, the business happened in India and business profits were earned and received in India long back, that is 19 years back. Now it's only being transferred into the Indian account. So definitely it's not taxable. And income from property in India, but received in USA. And once the property is located in India, the situs principle will apply and it has to be brought to tax in India, though it is received in USA. So 45,000 would be taxed here. Income from a property in London, but received in Delhi. The property is in London and received in Delhi. Receipt in Delhi sometimes create all the problem, and it is like a receipt of income in India might bring it to tax, and that 1,50,000 would get taxed here. And the next one is income from a property in London, but received in Canada, no problem, not taxable. Learning from a business in Zambia, but controlled from Turkey, is not to be taxed here. So altogether, we have arrived at 4,45,000 is the taxable income of Mr. Ram in India. So tax residency, then we are quickly getting into what you say Section 6 provisions and what are the recent changes that have been brought in. We need to bear in mind. As explained little earlier, the concept of residence is very critical for us to define or understand the scope of a non-resident or a resident or a not ordinary resident, or whatever it may be. So tax residence is one of the main decisive factors for establishing the category of taxpayer. And then residential status of a person is a key factor in determining his or her taxability in a particular country. So now we are talking about the scope of non-resident. We are telling if at all it's a income accruing outside India or received outside India, definitely it is not to be brought to tax in India if it's a non-resident. So that way, what is going to be taxed in this country and what is going to be taxed outside India is always decided on the basis of the residency. In India, tax residency is determined on the basis of Section 6. Indian government introduced recently some important amendments as anti-avoidance provisions that largely base its premise on citizenship. So citizenship is a concept which we have borrowed for the first time here in the Indian residency rules, which we'll discuss. So quickly looking at the residential status, for individuals and HUF, you have resident, non-resident, and deemed resident is a new concept now which has come in Finance Act 2020, which will be explained in the subsequent slides. And to a resident, you will have resident and ordinary resident and resident and not ordinary resident, RNOR. Then coming to non-individuals, that is firm, company, and AOP or BOI, there could be only a resident or a non-resident. There is no question of having the third status of not ordinary resident. That is only possible for individuals and HUF. So firm, company, and association of persons and all that, whether it could be resident or a non-resident. Then the basic rules of Section 6.1 says, if at all an individual is in India for physically present in India for 182 days or more, he will become a resident in India, or he is available in India during the previous year for 60 days, and 4 years preceding to such previous year, he was there for 365 days or more in India. So the preceding 4 years are always the preceding 4 financial years or the accounting years. As we know, under the income tax law, it is the financial year that is to be considered. So you also should look into the earlier 4 years, 4 financial years, and not the 4 calendar years. Calendar years ending with 31st December, that you must bear in mind. And in fact, this was also supported by a case law. And explanation 1 is a explanation to give some sort of exceptions here. In case of an Indian citizen or member of a crew of a ship who is leaving India for employment, the 60 days specified as a basic criteria shall be replaced with 182 days. That means unless that Indian citizen is there for 182 days or more, then only he will become a resident in India in the year in which he leaves for employment abroad. In the same way, a member of a ship, of a crew of a ship who goes outside India. In case of an Indian citizen or a person of Indian origin being outside India visits India, the first clause talks about a citizen leaving India for employment, and the second clause B talks about Indian citizen and also a person of Indian origin. There is only Indian citizen in clause A. Here you have Indian citizen and also a person of Indian origin. If they are coming to India for a visit, please mark the most important thing is visit. If it is not a visit, if the Indian citizen is coming for good, resigning his employment, then probably this exception would not apply. So you need to bear in mind, you will have to decide the nature of his arrival in India, whether it is a visit or whether he has come back for good. So that is very important. Even person of Indian origin, in both cases, you need to ensure that he is on a visit. When once he is on a visit, the 60 days would get replaced by 182 days. Unless that person stays here for 182 days or more, he would not become a resident. So if at all we go by 61C, the 60 days will make him quickly a resident here. Though he comes on a visit, that is the reason that leverage is given, that extra flexibility is given for those who are coming on a visit to India. Here, there is an amendment that has been brought in the Finance Act 2020. Indian citizen or person of Indian origin who has income, Indian income, exceeding 15, that is income other than coming out from the foreign sources, if it is of the Indian source income, exceeding 15 lakhs, more than 15 lakhs in the previous year, that 60 days will be substituted by not 182 days, but it would be substituted by 120 days. That you need to bear in mind. 120 days, Finance Act has brought in specifically. This is being brought in with the intention, the purpose behind this amendment is individuals who are actually carrying out substantial economic activities from India manage their period of stay in such a manner they always remain as non-residents in perpetuity. They manage in such a way that they stay here almost for 6 months, just for 181 days or little less than that, and get out of India and come again next year. So suppose if it is the two, because you need to count this 182 days in each accounting year or a previous year, there is a chance, if at all he comes in the month of October, he can be there October, say on 5th or so, if at all from October 5th or 2nd, if he stay up to 31st March in a particular financial year is less than 182 days, he can continue his stay for the next almost 6 months and ensure that he is not there in the next financial year up to 182 days, less than 182 days. That means almost he is staying here for 10 months continuously and trying to manage his business activity or economic activity, and still he is claiming himself to be a non-resident. Once he is a non-resident, what happens? Though whatever income that is being earned outside India, with the nexus or with some sort of control in India, is not going to be brought to tax in India. Though control is there in India, still if it is getting accrued and arising outside India, it would not get taxed because he would continue to maintain himself as a non-resident. So that is what is being checked now. His stay and the flexibility is being brought down, so he cannot stay more than 119 days. That means once he stays 120 days or more, then he is getting caught and he would be taxed in a different way, and what he would be treated and all that we will see. It is entirely possible for an individual to arrange his affairs in a manner that is not liable to tax in any country. And then there is also one more amendment coming to section 1A, that is subsection 1A has been brought in by the Finance Act 2020, which says if an individual is only connected to citizen, please bear it in mind, the earlier amendment relates to citizen as well as to a person of Indian origin, but here it is only a citizen. So this is where the concept of citizenship has been given all the importance in the taxation law of India for the first time. Of course, the citizen is considered for the purpose of exceptions and duration of stay in India, but here what is being proposed or what has become a law now under section 61A definitely talks about a different approach, which says irrespective of his stay, he need not come even for 1 day to India. And if he has more than 15 lakhs Indian income, could be a property income, could be any income what is accruing or arising to him in India or received in India. That 15 lakhs income, exceeding 15 lakhs income is there, he is a citizen, then he shall be deemed to be a resident in India, provided he is not liable to tax in any other country or territory for the reason of his domicile or residence in any other similar criterion. So there are countries like UAE, United Arab Emirates, Dubai, where there is no personal taxation. So if at all he is not liable to tax in any country outside India, then he would be a deemed resident of India as per section 6(1)(a). When once this is proposed, there was a lot of hue and cry last year. Many representations were made. Then they have quickly made some more changes to the proposal to make it more palatable, to make it more sensible. So the memorandum to finance will state that these amendments are aimed at stateless persons who claims themselves to be non-residents in every country. They say, I'm a non-resident here, I'm a non-resident. So nowhere he is a resident and he will escape tax. This is mainly targeted against such individuals. And demystifying the deemed residence doctrine, the intent of deemed residency based on the Indian citizen may be to tax those who are stateless, mainly the film stars, sportsmen, and other similar persons. Take an example of this Indian citizen stayed just 40 days in India, 130 days in Singapore, 110 days in England, 85 days in Dubai, and he has income exceeding 15 lakhs. He is not a resident in any state due to his lesser stay and all. He may be a deemed resident now as per the as per the new amended provision. So a citizen of India can normally be judged by the from the passport issued by the Indian passport authorities. Then he can be treated as a citizen of India. CBDT, via its press release on 2nd February 2020, immediately after presenting the bill in the Parliament, it has been clarified by the board that new provision is not aimed to include to tax net in those Indian citizens who are bona fide workers in other countries, including Middle East, because there was a lot of hue and cry, and countries like UAE, where many Indians are working there, because there is no personal taxation. If you strictly apply this rule without the exception, they would be brought to tax. Who are not paying taxes on their salary income there would get taxed here, as per the 6(1)(a) by the deeming provision. So this is where a quick further amendment, and it has been clarified, no such salaried employees would be brought to tax. So there is a further, amendment which says section 6(6) has been further modified by the Finance Act 2021, which talks about not ordinarily resident. We know a person who is non-resident for 9 out of the 10 years preceding the relevant year is to be treated as a non-resident. We all know that. Sorry, is to be treated as a not ordinary resident or stayed in India for less than 730 days during the 7 years preceding the relevant year. To that, there are 2 more clauses that have been added by the Finance Act 2020 to bring in line with what is proposed earlier. Indian citizens are PIO, that is the person of Indian origin, who are classified as a resident on account of reduction of the period for which they can stay if they come on a visit from 182 days to 120 days. If at all by any chance they stay for 120 days or more than 120 days, having Indian income more than 15 lakhs, then such person would be treated not as a resident, but he would be a not ordinary resident, because RNOR. What happens RNOR? RNOR is also not liable for tax in respect of any income earned outside India, except income received outside India, but from a business controlled in India, or from a profession set up in India. So that is very important. If at all a medical doctor sets up his profession in India, he became very popular, and he continues his profession in India through his colleague doctors and all that. And this gentleman goes and sits abroad, and with the goodwill he has earned and the standing he has earned, he goes and starts earning abroad, and he continues his citizenship in India, then such cases would get caught by this amendment. And whatever he earns outside India would also be deemed to have been earned by a profession which is set up in India and that would get engulfed in the scope of taxation in India. So that you need to bear in mind. So same way, if a business is earning profits outside India, but business is still being controlled in India, that is good enough to rope in even those profits of the citizen, though he's a non-resident, he would be classified as not ordinary resident, and it would be brought to tax here. Okay, in the same way, the 6(1)(a), that is the new provision which says if you are just a citizen of India, and you have more than 15 lakhs Indian income, and you are not liable to tax in any country, that is good enough for the Indian government to treat you as not resident, but not ordinary resident. Even such person also would be deemed as not ordinary resident. So these two amendments, that way, these two categories of persons would be treated as not ordinary resident, and thereby what is getting taxed extra, that is what is captured in this slide. Persons falling in the above criteria will have to pay tax in India for the foreign income derived from a business controlled in India and a profession set up in India. Foreign income derived, it was derived abroad, but from a business controlled in India or from a profession set up in India, that is good enough to bring these categories of items of income into taxation in India on the basis of this one. So, if at all there is a genuine case where the residency continues even abroad in one of the countries, then you need to depend on tiebreaker rule under the tax treaty of the respective country, and then you will try to solve this issue of residency, dual residency, because you are being treated as a resident in India and also resident in that country. The dual residency would be broken to ensure that you are only a non-resident of that country, non-resident of India and resident of that country on the basis of the tiebreaker rule you have in Article 4 of the respective treaty. This is what you need to bear in mind, and the term that would be explained in the later slides. And the term stay in India includes stay in territorial waters. If at all an individual is employed as a member of a crew of a ship, as long as the ship is in territorial waters of India, he is deemed to be in India physically. And it's not necessary that the period of stay must be continuous. It could be sporadic. All days of stay put together, if they are crossing the threshold prescribed in the rule, then he would be deemed as resident or non-resident, respectively, accordingly as per the duration of stay. For counting the number of days stayed in India, both date of departure as well as date of arrival would be considered. To be more precise, on the date of departure and date of arrival, the number of hours he was available here would be more appropriate for us to decide how many days. Suppose he is available only for 12 hours, probably it can be taken as a half day. That is how it has to be done. There are case laws that support this approach. And then HAF is a resident in India if control and management of its affairs is wholly or partly situated. It would be only a non-resident only when the entire control and management is outside India. Subbaya Chettiar's case, 18 ITR, is a very instructive judgment in this regard. One can look into that. Subbaya Chettiar, 18 ITR. He has been resident in India in at least 2 out of the 10 previous years, or he has been in India, that is with reference to Karta or the manager. If he is there for more than 730 days, then he would be, HUF would be treated only as an ordinary resident. Then a partnership or an association of persons resident in India, the control and management of the affairs are wholly or partly. That means even if part of the management is in India, it is a resident of India, non-resident only when the entire control and management is wholly situated outside India. And then section 6, subsection 3 is with reference to companies when it is said to be a resident in India in a previous year, if it is an Indian company or place of effective management in that year is in India. So section 6, subsection 3 is on the POEM guidelines. This is a session by itself. I'm not going to spend more time on this. If you all remember, We had an international taxation, a refresher course conducted by Pankaj Trivedi in the month of January. That time we had a full-length session on poem. Poem is always a session by itself because of the guidelines given, and the concept itself is a very, very important concept which has come into the Indian statute from last 4 or 5 years, and we need to be. It has become effective from what you say. I think 17, 18 assessment year onwards. And then poem means a place where key management and commercial decisions that are necessary for the conduct of the business of the entity as a whole are in substance made. We have clear guidelines given by the January 24th of 2017 circular, wherein the guidelines, poem guidelines are given. And there is a subsequent circular which says where the company's turnover or gross receipts are 50 crores or less in a financial year, then poem guidelines would not apply. If it is a company, an Indian company, definitely it is a resident of India, no doubt about it. If it's not an Indian company, that is not registered in India, whether poem of the company is in India, that is the place of effective management, though it is a foreign company, if the place of effective management is in India, then definitely it would be treated as a resident of India. There are many cases where parent companies are in India, subsidiaries are outside, but they are virtually managed from India, and subsidiaries are treated like branches by the Indian parent companies, and everything would happen here. Such approach of management would bring the most undesirable consequence of making such company a resident of India by the poem rule under section 6, subsection 3. And if at all the poem is not in India, definitely such foreign company is to be treated as a non-resident company. And section 6.4 talks about any other person and control and management of his affairs unless it is wholly situated outside India. If partly if it is situated in India, then it would be a resident, even if it is partly situated. Unless it is wholly situated, it cannot be treated as a non-resident, as such person. And if there's a particular source in a previous year, the person is treated as a resident, and he would be a resident in respect of in every other source of income of that previous year. That is section 6, subsection 5. And in treating the dual residency that may arise on account of this 6.1a amendment and also explanation 1's amendment in clause B, there could be situation of dual residency, and there could be a genuine cases where the taxation, there could be a double taxation on account of the amendment in India. And in such case, one should resort to the tie-breaking rule under Article 4. And if the tie-breaking rule is able to help him get out of this, as you know, the tie-breaker rule, we have got the criteria of place of permanent home. Then we have to see the tiebreaker rule in Article 4. One gives various criteria for us to examine and ensure that he is identified as the resident of only one country and not both the countries. Whether he has a permanent home, if at all the individual has got permanent home in both the countries, then probably he would not be, that cannot decide resolve the dual residency, and we have to go to next level, that is Center for Vital Interest, Economic and Personal Interest. Here you need to consider even the cultural interests also and economic interests. If these interests are evenly divided between both the countries, even that criteria also cannot decide his residency, and then we will have to go to the next tiebreaker rule, that is the habitual abode, that is stay for business or leisure. Wherever he comes and stays, it need not be owned by him. If at all where he comes and stays, what is his, where he has a habitual abode, whether the habitual abode is there in India or abroad in that country, let it be UK, USA, or whatever it is. If even there, if you come to a conclusion that the habitual abode is there in both the countries, then even that criteria cannot resolve the issue, and we'll have to go to the nationality. And when you talk about the nationality, nationality is a bigger set than citizenship. Citizenship is a smaller set. That is, a citizenship is a subset, and nationality is a bigger set. Every citizen is a national, but every national is not a citizen. State Trading Corporation, Supreme Court has categorically held one needs to go into the State Trading Corporation's case decided by the Honorable Supreme Court. And then if at all he is national of both the countries, then the competent authorities of both countries, that is we have the Joint Secretary of Foreign Trade, Foreign Division of CBDT is our competent authority, and we have Rashmi Ranjan Das, now one of the competent authorities in India. Earlier we had Rajat Bansal and Prajna Saxena. So that competent authority is one who is authorized to negotiate the tax treaties, and he is the same person who will take up the treaty-related disputes and resolve. Both the competent authorities of both countries should sit and resolve the dual residency issue. If at all the earlier parameters of tiebreaker rules is not going to give the solution, then we are now, friends, we are coming to business connection 911. So business connections, anything, Pankaj, you want to say?
There were some questions which are raised on the topics which you have completed.
Okay. Shall we take up all the questions at the end, or shall we break here?
Your comfort, if you will have some respite, we can take those questions.
Okay, I don't mind taking just 2 questions. If more than that, we will push them to, and the other questions also we'll handle at the end.
Okay, then continue. We have 9 questions, so after this we'll ask, not a problem.
Okay. So coming quickly to business connection. Business connection is the most important concept in 911. That's a deeming concept whereby 2 conditions should be satisfied. The taxpayer has a business connection in India. By virtue of such business connection, income actually arises, though arises outside India, would be deemed to arise or accrue in India. If the above 2 conditions are satisfied, income would be taxable, though it is arising outside India because of the business connection. It would be deemed to accrue or arise in India. Only such part of the income as is reasonably attributable to the operations carried out in India would be subject to tax in India. A business connection can arise between a non-resident and a resident. Generally, the business connection happens that way only. A non-resident would have some sort of link to the Indian territory in the form of an agent or in the form of a business partner or business associate. Some sort of linkage can bring in the business connection, by virtue of which, though income is accrued or earned outside India, would still be deemed to have accrued or arisen in India on account of business connection. So for this, we need to look at intimate relationship, close and intimate relationship, and it's not a stray relationship. If at all the transactions are happening just once in a way or once or twice in a year, that may not really result in business connection. So for this, we have case law, and we need to see how we go about. So quickly, as I mentioned in the beginning of my presentation, section 911, I'm only confining myself to the business connection concept, and I'm not getting into indirect transfers or royalty payments, FTAs, and other criteria under 9.1, which are going to be taken up by my beloved friend, Mr. K.R. Shekhar tomorrow. So, quickly coming to the explanation 1, business other than SCP. SCP is also going to be taken up by the young dynamic speaker, Siddharth Banvat, day after tomorrow. SCP is going to deal at length, and significant economic presence is a new concept of business connection being brought into the statute and becoming operational from assessment year 22-23 in the light of the digital economy, in the light of digital taxation. Okay, that I will discuss at the end, and on a broad basis, not in detail. Only such part of the income as is reasonably attributable to the operations carried out in India would be deemed to have accrued and arisen in India. So that is what you need to bear in mind. What is reasonably attributable on the basis of the operations carried out is the crux of the issue, and the assessing officer cannot be over enthusiastic to bring the entire amount to tax here. That is what in Galileo's case, when Evo was trying to tax the entire €3 being collected from each customer as the processing fee for the travel bookings. And the tribunal said it can't be €3, it is only 15% of that which can be attributed to the business operations in India. There is a business connection, but the attribution cannot be the entire amount, it should be only 15%. So that is what is endorsed by the Delhi High Court also. Then you have others, that is no income. There are certain exceptions given in explanation 1. If at all the non-resident is running a news agency or publishing a newspaper, etc., whose activities are confined to collection of news and the views in India for the transmission outside India, then that such activity is an exempt activity, and such activity, though it's carried out in India, it would not result in business connection. In the same manner, with reference to shooting of cinematographic films in India, that is an exempt category, and it would suppose the Hollywood team comes here and does some shooting here in Agra, Taj Mahal and other places and the other historical places in India, that would not amount to any sort of business connection in India. In the same way, if the operations of the non-resident gets confined for purchase of goods for India in India, it's only purchases that are happening, then it would not result into a revenue raising activity. Thereby, it would not be treated as a business connection. So that is what you need to bear in mind and should be. And then quickly coming to the explanation 2, that is agency business connection. That is an agent who has habitually exercises in India an authority to conclude contracts. See, you have an agent, business activity carried out through a person, and that means the non-resident has appointed a person who is an agent for him, and he is carrying out the following actions. If these following actions are carried out, then he would be treated as an agent who would trigger business connection for his principal in India, who is a principal who is a non-resident would trigger business connection in India. And that agent is habitually exercising in India an authority to conclude contracts on behalf of the non-resident principal. And now it has been enlarged. Habitually plays the principal role leading to the conclusion of the contracts is what is amended by the Finance Act 2018 itself. Once the BEPS action plans are in place, and once the MLI is signed and all that, then an immediate amendment has been brought in by the Indian government to rope in even such agents who do not have authority to conclude contracts, but they are virtually playing a pivotal role in conclusion of contracts, except doing the basic action of concluding contract by signing. Except that everything else is being done in substance, they are playing a principal role in conclusion of contract. That is good enough. Now the approach is substance over form, and habitually concludes contracts. And the third one, maintains in India a stock of goods or merchandise from which he regularly delivers goods. Even that is also a very important thing that is captured in the next slide. That is, one is the conclusion of contracts. The second one is playing a principal role in conclusion of contracts. And then the third one is he has no such authority of conclusion of contract, but habitually maintains in India stock of goods or merchandise from which he regularly delivers. That is good enough to trigger the agency business connection for a non-resident principal outside. Habitually secures in India mainly or wholly for the non-resident, for the other controlling or controlled common interest non-resident. That means habitually secures orders in India. This habitually securing orders in India, this wording is also there in India-Singapore tax treaty. So these are all the actions of an agent in India who represents a non-resident principal outside. These actions would trigger business connection for such non-resident principal. Independent agent working at arm's length and serving not just one non-resident principal, but he is serving many such non-resident principals, then it would be in the course of his regular business and it would not be treated as a business connection for any particular non-resident principal. And significant economic presence, I'm not going to spend time on this because you have a full length session. Significant economic presence is a concept being brought in line with the digital taxation proposals happening at the OECD G20 level, part of the BEPS agenda. Because the whole issue now is, as in the past, you don't require physical presence for corporations to make earnings in the source country. The classic examples are like companies like Google, Facebook, and all that. Without any physical presence, they can earn billions of dollars through digital means. So there must be some sort of new rule to bring such transactions to tax in source country like India. This is where three concepts have been proposed by the action plan one of the BEPS agenda, wherein you have one is significant economic presence, the second is equalization levy, and the third one is withholding taxes. So, all three, the equalization levy, significant economic presence, and all three are almost brought into India in one shape or other, because India is an aggressive tax jurisdiction and is a front runner in implementing these tax anti-avoidance measures. And in fact, for the significant economic presence, with respect to transactions like download of data of a software in India being made available by a non-resident provider, and systemic and continuous soliciting of business activities are engaging in India. If the users are there in India, that users themselves will create an economic presence for the non-resident here. That is for what a detailed discussion would happen day after tomorrow in the session. And it is irrespective of whether or not the agreement or for such transactions or activities is entered into in India or not, irrespective of whether the non-resident has a residence, a place of business in India or not, irrespective of whether non-resident renders that services in, he need not have to come to India to render those services. Irrespective of all these factors, it would be deemed that there is a business connection for that particular non-resident on the basis of the significant economic presence principle. So only so much of income is attributable relating to the operations carried out in India. And SAP is one of the options, as I suggested, by the BEPS action plan, and SCP concept has been brought into the Act, and equalization levy is already brought as a non-income tax measure. It is not covered by the income tax law, but equalization levy 1.0 and 2.0 are in place. Equalization levy 2.0 is targeted to cover non-resident e-commerce operators. And it may also be noted that India has expressed a reservation in 2017 stating that the digital taxation approach through SCP would be carried out. That is what India has always been claiming. And it's one of the first countries to bring the concept of SCP and equalization levy in the, they have become reality, became law in this country. Government has clarified that the same approach of SCP would be brought into the tax treaty network also in future. And then the income attributable to the operations carried out in India shall include the advertisement, sale of data collected. This is all explanation 3A, which will also be covered in the next session, that is day after tomorrow. The coming session on day after tomorrow. And for these items, some sort of thresholds are notified, especially with respect to significant economic presence CVDT on 3rd May. It has given a notification because this SCP concept is going to be made effective from 22-23 assessment year. Revenue threshold of 2 crores is given, and user threshold of 3 lakh is given. Thus, the non-resident who satisfies the above threshold would trigger SCP business connection in India, and he would be exposed to tax. Of course, this SCP business connection would be triggering only in those cases of non-resident where those non-residents are located in such countries with whom we don't have a tax treaty. Then this domestic law approach of significant economic presence would trigger. Otherwise, if they are covered by a treaty, that means their country and India has a treaty already. then there is no way you can apply this, because the treaty provisions will override, and the concept of permanent establishment as is existing in the treaty would apply, and not this SCP concept. And anyhow, we have SCP and equalization, both are in place now. And it would also try to rope in some sort of indirect income also into this SCP ambit, that is the business connection ambit, which we need to be careful and ensure that such indirect income must be linked with the operations carried out in India. Otherwise, such indirect income cannot be attributed to the Indian taxation computation. Aspects relating to the characterization of payment as royalty for fees and technical services, share sale, and all may now require deeper analysis due to the possible overlap from a business perspective, business connection perspective. And this is with reference to indirect transfers. I'm not going to discuss for want of time, because indirect transfers is going to be dealt with by Mr. Shekhar tomorrow. So I'm not going to, because we are running short of time, and this is also with respect to the indirect transfers. And then electronic business connection. Digital economy is increasingly becoming the economy itself, making it very difficult, if not impossible, to ring fence the digital economy from the rest of the world. That is what is observed in the Action Plan 1 by the OECD BEPS initiative. With the advancement in information and communication technology in the last few decades, new business models operating remotely through digital medium have emerged. So that is what you need to understand. The new business models are in such a manner that the bold international tax rules are not in a position to capture them for taxation. Though we all pretty well know that the presence of these multinationals like Google, Facebook, and other corporations in India is significant, we are not in a position to tax such corporations, the revenue generation in India, because the old rules are not in a position to capture such activity as a taxable activity in India. That is what we need to bear in mind. That is the reason OECD G20 BEPS initiative has now brought in Pillar 1, Pillar 2 proposals for discussion, and US being the major economic force is not agreeable to that. Though US has participated in all the OECD G20 BEPS initiative, US has not signed MLI and also not approved what you say, I'm sorry. I'm sorry, something was wrong. What I mean to say, USA has not signed, and we need to really wait. It has not given its green signal for Pillar 1, Pillar 2 proposal, which is stalling the entire initiative of digital taxation. And Pillar 1 has proposed how digital corporations, how digital businesses and consumer-facing businesses have to be taxed in a broad manner. But whereas United Nations has come out with Article 12B proposal to address automated digital services, Article 12B is chiefly called as Rajat Bansal's proposal. The earlier competent authority who got promoted and who is in the UN committee representing India has become so popular. His proposal is called Article 12B proposal, which seems to be more realistic than the proposals made by the OECD. So that is how the digital taxation is at the most happening stage now. For want of consensus, the thing is delaying, but definitely it could happen someday or other in the near future. And the significance increases as the ratio of international transactions or intra-nation transaction in case of digital economy is quite high, and the digital transactions are increasing phenomenally, more so post-COVID. More so, all of us, we got used to do so many digital transactions sitting at home. Online, you order the goods. Online, you order the services, and so many things, payments online you do. So many, we got used to so much of digital transactions. And then this is what I have already explained, and India is one of the front runners in adopting some of the unilateral measures. This equalization levy is a unilateral measure. pending consensus that needs to be arrived at the global level, at the OECD G20 initiative. Once consensus is there, countries like India have promised to withdraw equalization levy, which is a unilateral measure. Such unilateral measures have been brought in by many countries because the digital transactions are happening in phenomenal way, and no country is ready to postpone their collection of taxes in the legitimate manner. But of course, the way in which these unilateral measures are being administered, definitely there are so many flaws in that, and there are so many violations of the international obligations that we will discuss in a different session. And taxation of digital economy, we need to really focus on these A to E items: appropriate nexus of income to a virtual permanent establishment, profit attribution for digital economy, characterization of income, indirect taxes, and amendments to transfer pricing order. These are all very important aspects that need to be looked into when you finalize the digital taxation rules. As I mentioned to you, digital taxation is not happening on account of lack of physical presence. They don't require any physical presence to carry out their business operations. So that is why now new rules are being discussed and are being prepared. And I will just spend 5 minutes or 10 minutes time in quickly, 5 minutes time in quickly running through the case law. Some case laws I will leave it to the, so that we'll have at least 15 minutes time for discussion of the question answers. Is it okay? Right.
Yeah,
So,
okay.
these case laws, as I have explained the facts in detailed manner in the slides, you can definitely look into the case law, read the case law, and understand the purport what I have given. But I will try to quickly run through some of the concepts in this case law. In this case, this is Anglo-French, this thing. In this case, entire sourcing of raw material was done from British India, while manufacturing activity was carried out in French India, that is Pondicherry. We used to have two colonies, principally, if I remember right. That is, one is the French colony, and the other one is two or more than two colonies. The one is French colony, definitely was there, and the British colony. And British India and French India are two different territories within the India, and also sales were entirely outside British India. The Supreme Court observed that Desi had a business connection in India on account of the sourcing operations in India. And sourcing operations in India triggered business connection. That is what is held in the Anglo-French textiles. And it's a very interesting case. And continuity of business relations between non-resident and a resident of British India constitute business connection under the Old Act of 1922. It's a very interesting case. Please go through this case law and understand the concept of business connection. And then you have the next case, Barendra Prasad Ray. Here, appellants were acting as solicitors of a German corporation. Some matters have to be argued in the Indian courts, in the Calcutta High Court, and they have decided to engage one lawyer who is a resident of UK. He is named as BW in the case. His name is Barendra Prasad, and he is engaged by the Indian lawyers to invite him and engage him and request him to argue in the Indian courts, and all that has happened. And there was a conclusion taken by the Calcutta High Court stating that there was a correspondence between the appellants and the AM company, which engaged BW, that there was a connection between the appellants, and appellants are in India and BMW in UK. And so BMW has a business connection in India. So whatever payments you make to him should suffer tax in India, is what is decided in this particular case. And then you have is a commission agent. This is R.D. Agarwal's case, 56 ITR. There are two non-resident exporters who boasted Gulanyan. Here in this case, the business connection has been explained in detail. We must know where business connection happens. Business connection happens on the basis of close and intimate relationship. This is what is explained in this case law by the Honorable Supreme Court. It is not on account of stray or isolated transactions you will trigger business connection, but it is on the basis of a continuous or a frequent flow of transactions that would trigger the business connection is what is upheld in the case R.D. Agarwal's case, which case is obviously, always studied by any international tax student. Existence of real and intimate relationship between trading activity outside and within taxable territories is necessary to constitute business connection, is what is R.D. Agarwal's case. And then in the Cochin International Airport, here I will quickly explain, there are two companies, one company from UK and one company from UAE have been given contracts with Cochin International Airport to run the duty-free retail outlets. Okay. For this purpose, they entered into a tripartite agreement. Cochin International Airport entered into, that company entered into agreement with these two companies, one from UK, one from UAE. And these two companies are going to receive 2% as commission fee on the gross sales from the duty-free retail outlets set up in the airport. And 1% is going to be received by the Riol. Riol is a company, Riol Trading from UAE. So the question is, the SSE deducted tax at source 195 only on the payments made to Alpha, and no tax was deducted on the payments made to Riol of UAE. But AO held that SSE is liable to deduct tax under 195 on the entire commission. That is what it has held. Not only that, AO held that the commission fee can be considered as a business connection, he said, and aggrieved SSE preferred an appeal before the Cochin IT80. IT80 said, just because they have, in fact, these two companies, one from UK and UAE, have a joint venture company set up in India, which company is anyhow getting taxed to India, with which company they have some transactions, and directly they are not involving themselves. The fact that the general manager and assistant general manager of this particular Indian joint venture company, which is held by these two non-resident stakeholders, is carrying out some operation in India with respect to this business, and thereby the IT80 opined that revenue authorities erred in holding that Alpha and Riol had business connection in India because they have their own joint venture company which is doing the major business activity, and whatever these two have done sitting there as investors or the know-how suppliers, and whatever commission they are receiving, that is good enough, and you cannot tax anything more than that, and that is what is held. It is held in favor of the SSE. And Convergys is a case. In brief, I will explain. Convergys US has got Convergys India. Convergys India is virtually, that is a subsidiary. Convergys India is serving only its parent Convergys USA, and it's carrying out all the BPO operations required are outsourced by its parent to India. And this is enabling US parent to meet the customers' requirement in US and other places. And this is what is identified or agreed by the High Court that the prima facie indicate that there is a business connection. The role of the subsidiary is to provide customer management services in fulfillment of contracts negotiated by the petitioner for its US bill. Petitioner is the US, that is Convergys USA. So here in this case, the Indian company is virtually treated like a branch of the US company, and it is doing all activity, which is the core business activity for the benefit of the US company. Therefore, it was held by the Honorable High Court, Delhi High Court, that this results in business connection. And you have and they also mentioned that tentative belief about the existence of business connection fee is sufficient for issuing reopening reassessment notice. That is what is also held. And then Mumbai Tribunal, Volkswagen is a very interesting case. This is what I will explain, and then I will stop because the other 2-3 cases you can easily go through. And Volkswagen, what happened? Taxpayer, that is the Volkswagen Finance Private Limited, is an Indian company. Volkswagen and Audi India a division of Volkswagen Group, jointly planned an event in Dubai for launch of a particular version of a sedan in India, a version of a car model in India. While the event was held in Dubai, the purpose of event was the launch of new model of Audi car, Audi A811 and all that for the Indian market. The taxpayer had flown in about 150 people from India to attend that event, launching event conducted in Dubai. And for this event, these two have organized a celebrity from Hollywood, from Kim Productions Incorporated, a company incorporated in the US, facilitated the appearance of Nicolas Cage, a celebrity, for 3 consecutive hours in exchange. They have paid $440,000 US and other incidental costs. And the whole issue is the taxpayer in the Audi India, as a part of the arrangement, received full rights of the launch event, capturing the celebrities' presence across all platforms. For a period of 6 months, they can project all the visuals and all that wherein the celebrity appears promoting this product. And the taxpayer claimed that since the event took place in Dubai, the appearance fee was not taxable in India. Because it happened in Dubai, we cannot bring the payment made to that celebrity as an item of tax for India. That is what is argued by this taxpayer. Protesting officer held that the payment was taxable as royalty under 916 and also covered by Article 12 of the India-US Tax Treaty. Conclusion, on appeal, in fact, CIT appeals confirmed the AWO's action when it has gone to, the ITIT Mumbai bench also, IT held that income embedded in payment to international celebrity for participation in the event in Dubai was taxable in India, as it was an India-centric event and the target audience are in India, and therefore there was a business connection. Though you are doing outside the Indian territory, the whole activity is being done to capture the Indian market, to attract the Indian customers. So all that is done keeping Indian market in view. So you cannot avoid business connection. That is what is held, and it was held that you have to deduct taxes even if the payments made to the celebrity. And these are the 2 cases which I am not going to discuss. Vertex and the last case you have some agents case and all that. These 2 cases you can go through because it's already 6:35, and I want to spend at least 10 minutes quickly on some of the questions. Pankaj, you can please go ahead.
Yes, Prasad. Prasad, stop screen sharing.
Pardon?
If you can stop screen sharing, then it will.
Yes, yes. I'll do.
Prasad, am I audible? Yeah.
Yes.
Thank you.
A little bit closer your voice, Pankaj sir.
Acha, is it okay now?
Yeah, it's okay, sir. It's okay.
Yeah, the first question is from Vijay Kumar. Okay. If an employee works from home in India for a non-resident company abroad and his salary is credited to his overseas bank account, is it an income arising in India or not?
No, in the COVID times, that is what is the question, obviously.
Yes.
A person, I can understand the person has come to India, got stuck in India, and he's working from home in India for a foreign company. But actually the employer is outside. The services are being rendered for the benefit of the employer located outside India. The general approach is always the salary is taxed where the services are rendered. But we are in a peculiar situation on account of COVID. The services are being rendered physically in India, working from home, probably if we take that way. Probably digitally, you can still argue that digitally it is happening outside. There could be an argument. But be that as it may, there could always be a situation where we can say because he's located here in India, whether this would get taxed in India is an issue. Against which, for the financial year 2021, unfortunately, the CBDT has not clarified in categorical terms. They have issued one circular for clarification on 2nd of March 2021. I think it is a circular number 2 or something. On 2021, they have issued a circular running into some 9 pages. They have given one format at the end. Sum and substance of the circular is they have categorized SSEs, taxpayers into various categories as per Section 6. And they would say that if at all by any chance you get still covered in India as a residency, am I audible?
Yes.
Yes, sir. Yes.
If you are getting covered as a resident in India, then you go under the treaty law. You go to a respective tax treaty under Article 4 residence and all that, and then it would be resolved that you would not be liable for tax in India. Hence, we are not issuing any separate clarification. That is what they said. But I think they could have done something more than what they have mentioned in the circular. But unfortunately, that clarity they have not given, especially for the year 2021 financial year, which was expected in more clearer terms. But broadly, they have clarified that the treaty law would address this particular issue where it is not intended to be taxed in India. As per the treaty, definitely, see, generally the stay might have got restricted to maximum of 182 days, less than 182 days. And the treaty says up to less than 182 days stay outside cannot bring any taxation in that source country. Now here, the employee who comes into India, India is a source country. So the taxation can be avoided on the basis of the treaty rules. That is what is clarified by the CBDT.
And if he works as a consultant, will it be any different?
Pardon?
If the person works as a consultant.
Consultant is a very tricky situation again. Consultant is a very tricky situation, whether he would be covered by dependent personal services or whether he would come under independent personal service. Independent personal services definitely it would not cover, it would cover only the professional service. Then it would be a business activity. If it is a business activity, where is his permanent establishment? All this will come into play. So even for permanent establishment, the direction given is we'll have to look into the treaty law and look at the relief, giving the facts of each case separately. So you mean to say the employee is designated as a consultant and not an employee?
Yeah.
So in that scenario, whether the situation would change is what you are trying to question. Okay. So here again, he has to go by the facts and the treaty law and the clarifications given by the CBDT.
Okay. I'm moving to next question, sir.
Pardon?
Can I move to next question?
Yes, yes.
Is interest received on NRE deposit foreign income taxable?
NRE deposit, huh?
Yeah.
NRE deposit, as long as it continues as a non-resident,
It is taxed.
definitely it is not taxable. That is very clear.
Sorry. I am taking the next question. An NRI came to India during February 2020, just before COVID, and got stuck in India thereafter. He was employed in Singapore before he came to India during February 2020. He continued his NRE deposits up to 31/3/2021 and thereafter informed the bankers to convert it into local deposit.
And what he means to say, he continued here as and he didn't go back.
Yeah, he is now continuing, but till 31st March 2021, he continued the deposits as NRE deposit only. And the question is, what would be the taxability of interest on NRE deposit for the assessment year 21-22? He had fulfilled the definition of NRI under 2W of FEMA and also provisions of 10(4) of the Income Tax Act. See, basically,
for the assessment for the previous year 2021, his stay in India is for more than 182 days.
Yes.
But because of the COVID, but here, unfortunately, he is also coming out of his employment and is not ready to go back. No?
Yeah, because he has just stayed back here now.
He stayed back here and he has closed his employment outside, and then he is going to continue here in India. Yeah. Unlike people who have got back to their place of work outside, And this is a peculiar case where you need to look into the facts. At what point of time he has decided himself to continue as a resident of India. Even under the FEMA, the intention to continue as a resident is also important. So when he has decided, that is all a very subjective issue, because it's unlike a case where if he has got back to his employment, then the case would have been different. Be that as it may, coming to the NRE deposit, to my memory, NRE deposits interest is liable for tax the moment the person becomes resident.
Resident.
Okay, so that one needs to be careful. Only FCNR deposits continue to be tax-free till the deposit matures. So it should not be restructured. The same deposit, if it continues and matures till such time the interest is exempt, unlike NRE. So we'll have to carefully look at this case and decide, because here this gentleman has decided to become resident. So the conduct is proving that. So you can't claim my stay in India for the whole year 2021 is on account of COVID, I got stuck, he can't say. Because the flight started moving in between, and if at all he wants to continue his employment, he would have got back. So in this scenario, even approach under FEMA, which is the intention of the person to stay back in India, is very important. If at all that intention is evident from his conduct, he cannot he cannot avoid the implications of treating himself as a resident. So that anyhow we have to carefully look at, we have to take a holistic view looking at all these provisions.
I think the next question you almost answered. How about the deposits made in NRE and NRO accounts when he was non-resident? What will be the taxability once he becomes a non-resident or non-resident, not resident, but actually it should be resident but ordinary resident?
No, actually this is a different question, not that question. No, this is a different question.
It's a different question.
Can you read, because in the beginning I could not follow what you said.
Yeah, let me read it again. How about the deposits made in NRE and NRO accounts when he was non-resident? What will be the taxability once he becomes, actually the question should have been resident or resident but ordinary resident.
Correct, not non-resident. Okay, a non-resident made deposits into NRE account, that he can do only after he becomes an NRI. Okay, so the NRO account would have been maintained, would have been created once he has become a non-resident. The ordinary savings account or other accounts would get converted as non-resident ordinary account, in which generally the Indian income has to be deposited. Okay, whatever is earning in India as a non-resident, the rental income and other incomes would go into NRO. Okay, so that is what normally it is. And NRE interest is not taxable. NRE deposits interest, that we know, external account. And then once he becomes a resident, as I mentioned, the NRE external account, that is the deposit external account, will come to an end. The day he becomes a resident, the interest earned, he has to close that account. Under the FEMA regulations, he is not supposed to continue that account once he becomes a resident. Till he becomes a resident, it can be maintained. After that, it becomes taxable. And the NRO interest is always taxable, whether he is a non-resident or a resident. Yes. Next question.
Yeah. She's talking about the illustration.
Pardon?
The next question is on that illustration what you had given.
Okay.
Why is the income received from business controlled outside India not taxable?
And no, he's probably talking about tea business of India, tea business in Nepal.
Yeah.
Is it the Nepal one he is referring?
No. Why is the income controlled outside India? Business is controlled outside India, not taxable in India.
Naturally, if the business is outside India, it is not accruing to India, no. If at all business is controlled from India, if it is business is controlled outside India, entire activity is outside India, there is no control in India, then how can that be brought to tax? So only, only a resident is not ordinary residents. The extra amount of extra scope of taxation is a business controlled from India. Business controlled in India. Probably the business is happening across the world, including India. And profession set up in India, and also he is doing profession outside. So once it is set up in India and he is doing outside, these two categories will be brought to tax in India for a non-resident, for a not ordinary resident. Those 2 years till he becomes a resident.
The next question, I think, I'm sure it's illustration 1 of the same thing. Ram's salary from former employer, how
Correct.
taxed in India when it is already taxed in other country?
No, that is the unfortunate situation. It would have been taxed in the other country in a different year. That is, after so many years, he is bringing it to India. Then there could always be an issue that this is on the basis of receipt, it is getting taxed in India. So, but there is a valid question posed by the queries, if at all it is already taxed in that country, during which year it is not live, during which year Ram is a non-resident, and now also he is a non-resident. But here, the only point to be remembered is you are bringing that amount into India can trigger a question of taxability in India. That is where you need to again establish, is it a receipt of amount or receipt of income? If you are able to prove that this is a receipt of amount and not income, income is already taxed, definitely there would be a layout. On a conservative basis, we have brought it as an item of tax to highlight that Section 5(2)(a) receipt principle can create a lot of problems. So that is where you have to be careful. You must create all the documentation to prove that that salary was already received in the foreign account earlier, and the same amount has been transferred here. Because the facts are such that that amount is being paid now by the former employer. So now by the former employer. It is not a case where it is a salary of the past, arrears not being paid now. It would be a case where he is paying the salary, he is giving some sort of amount, he has decided on paying it now. Whether if at all it is taxed in the past as accrued, then definitely you have a case to argue that it cannot be taxed here in India because it is only receipt of amount and not receipt of income. But if at all the crystallization of income itself is happening now, which amount is not identified or mentioned by the employer in the past, as a bonus he is paying it today, and it is directly received into the Indian account, then definitely there is an issue of taxation in India. So that is what you need to really figure out, because there is no employment relationship now. It can't be treated as a salary in that country now. So that is a former, the fact is very, very broad. Former employer, it could be an amount of arrears paid now. Arrears relate to the service already rendered. Or it could be some bonus which is not crystallized and getting crystallized only now. Even then, you can still argue it relates to my service and it should get taxed in that year, which is not taxed in that year. So it has to be taxed on the basis of receipt. So for and against arguments would be done on the basis of more detailed facts, whether such arrear is an arrear crystallized in the past or arrear given now. Arrear amount finalized now.
Sir, we have 2 more questions on this before questions start on business connection. So I will just take these 2 questions.
Then I am cutting into Gaurav Shingal's time.
Because that's what. So after just these 2, which are quickly, we can just do and then hand it over to Gaurav. And then time permitting, we can take back the other questions.
Okay. Prasad, sir, I'm enjoying your answers.
No, Gaurav is telling something.
Sorry, Gaurav.
No, Prasad, Prasad sir, what I'm saying is I am enjoying your answers. So by all means, please carry on with the answers. I'm enjoying them thoroughly. And I think they're going to be far more enriching to the audience.
Okay, so, fine. So then let us get going. Go with you.
Okay. The next question is, for not ordinary resident individual, any income accrue or arise from India is taxable. Then why the limit of 15 lakhs is not clear?
No. For non-resident, what is it? Not ordinary
For-
resident. Can you read the question again?
For not ordinary resident individual, any income accrued or arising in India is taxable.
Correct. Correct.
Then why the limit of 15 lakhs is his question?
No. What they have done, not ordinary resident, that is correct. See, they have put this 15 lakhs to such persons who have not come back for good. Who have not come back for good. They still are outside only. See, this 15 lakhs link is given with respect to deemed resident under 61A. That is a person who is a citizen of India, but he is a non-resident. He is outside. Okay. And he did not come to India at all, even for a single day. But he has 15 lakhs or more than, exceeding more than 15 lakhs Indian income. Then he is being treated as a deemed resident on the basis of citizenship. If you go to the US tax law, their taxing rate, comprehensive taxing rates are not based on the physical stay there in that country. It is on the basis of citizenship. If you are a citizen of US, you will be anywhere in the world, you will be liable for comprehensive taxes. That is, the global income would be brought to tax in US. That is what we are experiencing in many cases where the Indians who have stayed there for 30, 40 years, who have become citizens of US, they will have all the love for the mother country, and then they will come back for good, and they still maintain their citizenship of US, and they become resident and ordinary resident here, then they become dual residents, and the US will say, I will tax you for your global income, give me the entire income details of what you have across the world. Same thing, India will say, you are a resident and an ordinary resident, I will also tax your global income. So it is a dual residency conflict which needs to be resolved by the tie-breaking rule of India-US tax treaty. So that is what I have explained under Article 4 of India-US tax treaty. The tie has to be broken and it has to be decided to which country he belongs. Then only we can administer the provisions, otherwise it would be difficult. He must be identified as a resident of only one of the countries. So that is the reason, I don't know where I have taken you. He is talking about NOR. The regular NOR is person who comes back to India for good. And the first 2 years after coming back, he is an NOR. In that scenario also, he is taxed only on the Indian sourced income. That is the same items are getting taxed from the business which is controlled in India or which is directly earned in India. Okay. So that way, what these two persons, these two categories, though they are abroad, because of their stay for more than 120 days when they come for a visit, and being a citizen, not being liable to tax in any other country, they would become liable for tax in India as not ordinary residents. So there is a distinction between the two. You need to really make out that. That is very important.
So what I'll be doing is I'll just take one question and we'll hand it over to Gaurav and come back because there are 24 questions now. It will exceed. Okay, so just last question on this topic is a former employee receives in India his PF amount from US in later years. Whether it is taxable. Should a resident disclose his foreign income exempted or non-taxable in India in his Indian income tax return?
No, I feel again this is something, anyhow, PF, as per the Indian laws, PF what is received, is it taxable? No. PF, it is not taxable if at all he is employed in India and all that, as per our Indian law. But this is with respect to a provident fund amount which is being paid in respect to the employment carried out in US. So Indian government may still say this is liable for tax. Okay.
Unrecognized in India, no? But
again, we need to go into India-US tax treaty in respect of this and see. I'm not very sure to give a final answer on this. My gut feeling would be This is from an ex-employer. Would it amount to pension? No, this is not a pension. This is a provident fund amount. There is some 301 items which are provident fund items in US. So I am not very sure for the present to give a final answer on this. I think Gaurav would also help when he takes up his session and when he answers the queries. I think for this, whether this can be tied as a receipt relating to the employment and thereby it cannot be brought to tax in India, or is it getting covered by any specific article of India-US needs to be examined. India-US tax treaty. If you go just by the domestic law, then you are in trouble, because the domestic law provisions cannot recognize the provident fund of the other country amount as an exempt amount. So this is where we have an issue which needs to be addressed on the basis of India-US tax treaty. There are some articles with respect to post employment receipts we need to examine and address this issue. Any other query?
Yeah, no, there are 26 more queries. So what I'll do is I'll just stop it, Prasad, now. Okay. And we'll just hand it over to Gaurav. Yes. And time permitting, we can come back because yes. Now all the queries are on business connections. So Gaurav sir, thank you very much for waiting and not at all. Here. And meanwhile, Prasad can also have some sip of tea or something before he comes back to answer the other questions.
No, I would request Gaurav to just take up this query first. Gaurav, what is your view on this PF payment of the US? Because I'm not very sure on that particular issue.
Sir, actually, my answer is also, I mean, my level of knowledge is also only up to that very level at best. So I don't have any additional inputs on this thing.
Okay, fine. So please go ahead with your session. So I will see Pankaj, I'm just logging out of the session for a while. Again, I will join because I'm going home just 2 kilometers from my office.
Please.
From there again, I will join at the end. If there are any questions, we both can handle it for time permitting.
Thank you, Prasad.
If you have questions related to it, okay?
Right. And friends, before Gaurav sir starts, I have one request. Let him finish the topic and then you put the questions, because a lot of questions are coming before he is starting the topic. Request you to just hold on, see if he has covered or not covered, and only on the topics covered, if you can just raise the questions, it will help him also, and the order of answering will also be relevant. Thank you. Over to you, Gaurav.
Thank you, Pankaj, and it's an honor to be present virtually in this gathering with the luminaries such as Prasad sir, Chairman Macha Rao ji, Vice Chairman Deepak ji, Past President Sir Yu, and of course the Secretary Satish ji. Without taking up a lot of time, I will directly jump into the discussion agenda for today, and then I will take you through these relevant topics. So today we will talk about taxation of capital gains. That will be the center stage for our discussion. When we are talking about taxation of capital gains in the context of non-residents and foreign companies, we will talk about first the background, and I'm sure most of you would know it. I would just quickly give you a recap of the background. When is capital gain chargeable to tax in India? What is the accrual principle around it? In the accrual of capital gains, we always have a concept which is always in the in a controversy, which is called indirect transfer. But I will not take you through indirect transfer today because that topic will be covered exclusively tomorrow in tomorrow's session. I will also quickly remind you about the provisions for computation, capital gain tax rate, and TDS provision. But from there, we'll jump into the middle of things, the important part, which is the treaty provisions for taxation of capital gains. So there are specific treaty provisions for taxation of capital gains on immovable property. When you sell immovable property, then there are specific provisions which are applicable for transfer of shares, sale of shares, which is, I think, one of the most important part of our conversation, because what we see today around us is that a lot of companies which are present in India, either they already are held partially or at times wholly by their foreign parents, which undertake transfer of shareholdings as maybe as a part of a share sale maybe as a part of a regional sale, maybe as a part of the group sale exercise. There are a lot of other transactions in which what happens is it might be an Indian entity, but more investment is flowing in this time from foreign investors, which later on exit. So again, these kinds of scenarios are the ones where the discussion around capital gain taxation will be very relevant for you on a day-to-day basis. We'll talk about that. And then, of course, we have the residual clause, which has also given rise to a lot of headache in past about taxation of capital gains. We will talk about that. I will take you through some of the important treaties which contain capital gain clauses. I mean, most of the treaties contain capital gain clauses, but some of the important capital gain clauses of some important trade partners of India. We'll also look at quickly the domestic tax law provisions, certain special provisions for taxation of capital gain, sometimes in the case of offshore funds, NRIs, some exemptions. So this will be the bulk of our conversation today. We will also touch upon lightly a topic which will be, for instance, short stay exemption, exemption in the case of equalization levy already having been charged. So those are the kinds of issues that we will talk about in the second part, but the much briefer part for today's discussion. Sir, if at any stage you feel that my volume is not clear, please let me know.
Sure.
Thanks. So the charging provision for capital gain, particularly in the context of non-resident, is that when the capital gain can be said to have accrued in India, but when is a capital gain accrued in India? Well, Section 9 tells us when is a capital gain deemed to accrue in India. Although there's a distinction between accrual and deemed accrual, yet I believe that the indication of when a capital gain is deemed to have accrued in India is fairly relevant, and that actually gives us the guidance on when is a non-resident going to be taxable in India in respect of certain capital gain that he may have earned outside India. And the answer to this question given by Section 9 is that when that capital gain accrues or arises, whether directly or indirectly, through transfer of a capital asset situate in India. So if the capital asset, the one which is being transferred because of which the capital gain is arising, if that capital asset is located in India, then even if the gain has been earned by a non-resident, even if the consideration has been received by the non-resident abroad in his foreign bank account, still the gain will be taxable in India. That is the thumb rule for taxation of capital gains in the context of non-residents. Now, otherwise, in general, charging provision for capital gain is Section 45, which requires there to be a transfer and a capital asset. There are a few other charging provisions also in the chapter of capital gains, such as Section 46, subsection 2, but those are for very specific scenarios, such as liquidation, etc. How is capital gain computed? Well, we all know it, so just quickly taking you through it. We know we have to subtract from the sale price, that is full value of consideration, the cost of acquisition, cost of improvement, and transfer expenses. And in certain cases, we are allowed to index the cost of acquisition in case of long-term capital gains. But the one that I want to bring your attention to specifically is first provision to Section 48, which is particularly relevant for non-residents. Now, this provision gives the non-resident investors into shares or debentures of Indian company a benefit of exchange rate adjustment. It creates an exchange rate parity. It's possible that an investor may have made an investment into Indian shares 6 years back, and today he is exiting from it. Now, if we just allow that investor only indexation, that means we are giving him the benefit of inflation that has happened locally into our economy, but he's a non-resident. He may have suffered more inflation, less inflation, and that can be probably best guessed through an interaction of what was the TTBR and what are the TTSRs for the date when the initial investment happened and what is the relevant rate today. This TTBR TTSR adjustment is what is allowed to non-residents if they are selling shares in an Indian company or debentures in an Indian company, whether listed or unlisted. And that benefit is contained in Section 48. So we generally call it the exchange rate adjustment. Now, interestingly, the first provision to Section 48 says that if the investor invested in these shares or debentures in foreign currency, then this benefit is available. But what if he invested it, exited it, this time got Indian currency, maybe, and then he reinvested that. This time, the investment may not be necessarily in foreign currency, and yet Section 48 particularly allows, expressly mentions that the benefit of first proviso will be available. Now, mind you, because this proviso clearly says it's applicable only for shares and debentures, you cannot stretch it to other securities such as mutual fund units. Now, what I've done is I've tabulated here the rates of capital gain taxes in various scenarios. And therefore, you could have a lot of questions by permutation and combination of various kinds of assets, various kinds of holding period. So all those will probably be answered by this table. And therefore, let's focus more upon the more fundamental aspects of taxation of capital gain. So fundamentally speaking, what I would say is if you're talking about shares, unlisted shares, if they are sold, the capital gain tax, particularly LTCG tax rate, will be 10% without indexation, without any first provisional adjustment either. And if those shares are listed shares, then you can have an additional advantage that you can go to a lower capital gain tax burden too by allowing indexation if it's available. By allowing for the first provision if it's available, and yet applying a 20% rate. So this is the summary snapshot of the capital gain tax rates. Well, this is a slab rate, or this was a snapshot of the tax rates applicable in the hands of the recipient as a payer. What's the rate at which you have to deduct tax? So if you are, say, an Indian resident who is paying to a non-resident, for that matter, even a non-resident paying to a non-resident, what's the rate at which the payer has to deduct tax? It is also fundamentally on the same lines that if the shares which are being sold are unlisted shares and it's a long-term asset, then the tax rate has to be deducted. The TDS has to be withheld at the rate of 10%. For other assets, it's LTCG, where 20% rate is applicable. Now, mind you, when we are talking about TDS in the context of non-residents, then the relevant section is section 195. And section 195, please be careful, contains no monetary threshold, right? It can be for even a small value of shares being sold. That's point number one. It also applies to individuals and HUF. So a lot of provisions, under the domestic tax law, when the payments are made to residents, are not applicable to individual payers if they're paying particularly in personal capacity. Now, we get a question a lot of time where a buyer has realized that he's buying a property which is owned by a non-resident, right? An NRI maybe. And when he is buying that property, he has to deduct tax. There, the deduction of tax will happen in spite of the fact that the individual is probably a salaried person. He is not subject to, tax auditor provisions. And these are the conditions which are there in 194C, J, H, I, not there in 195. So even if you don't have any source of income, you are retired, a pensioner, yet you have to withhold tax under 195 when you are making a payment to a non-resident, say, for purchase of an immovable property. Another question which we get often is that, Mr. Singhal, at what rate do we have to withhold tax? We understand that. But on what base do we have to withhold tax? Do we withhold tax on the gross consideration that we are paying, the gross sale price that we are paying? So if we have to apply, say, 10% or 20%, that rate is to be applied to the entire sale price, or only to the capital gain element of it? Well, the technically correct answer to this question is that the Honorable Supreme Court has already said it, CBDT in its circular has already said it, that TDS percentage is to be applied to the income element and not to the gross consideration element. So if suppose there's a property that you're buying for, say, 5 crore rupees, but the seller is earning a gain of only 2 crore rupees because his cost of acquisition as adjusted was 3 crore rupees, then ideally it's only the 2 crore rupees of gain which should be subjected to the TDS rate. Having said so, practically what we have seen is that in large value transactions, immovable property, and even more importantly, shares, the buyer typically says that, look, I don't want to take a chance because my consultant is telling me that while the Supreme Court has allowed it, while the CBDT circular says that apply tax only on the income element, are we really the ones who should judge, who should do an assessment? What is the amount of income? How do we know? How do we know for sure that the cost base that you are insisting is your cost base is the right cost base? Therefore, a lot of time what we observe is that the buyers or their consultants, they insist that if you're so confident, why don't you bring us a lower withholding tax certificate, basically a certificate under section 197, in which the officer has agreed that, yes, I agree that this is the cost base, and after reducing it, this is the final value from which so much amount of tax is to be withheld. So this is a practical issue. What we have also observed is 95 out of 100 times when you approach the tax officer for this certificate, they naturally inquire in detail about this cost base. So if you just say that I acquired this asset for 3 crore rupees, they will say, no, nothing doing. First, prove it to me. So they will probably go into the details as much as asking you for furnishing a copy of your bank statement as a non-resident to prove that you actually did incur a cost of 3 crore rupees when you were acquiring it. And if you're getting into the issues of improvement expenses, then God help you. Also, when we are applying the treaty provisions, and we will talk about treaty provisions, how they are applicable to these scenarios, still what we have to be mindful of is that computation mechanism for capital gain is not given in any treaty. Treaties seldom ever get into, or actually they never get into, computational aspect. They simply leave that to the domestic tax law, even the OECD commentary says so. Which means, therefore, that if a capital gain is taxable in India, although the treaty has some relief, partial relief, no relief, then what is the value on which this capital gain will be computed? Will be computed as per the domestic tax law provision, which means that even the deeming provisions under the domestic tax law will kick in when you are calculating the capital gains. To give you an example, if suppose a non-resident is selling a property, then the capital gain will be computed with reference to the stamp duty value, because that's what section 50C says. And a non-resident can't say that, look, those are provisions in the domestic tax law, while I am opting for the treaty. Fine, treaty is only doing an allocation of taxing right, which means which country is allowed to tax it and which country probably cannot. It is not permitting any tinkering, or a treaty is not itself tinkering with the valuation mechanism, with the computation mechanism of the capital gain per se. And therefore, all these deeming provisions will apply. Another example, if a foreign company is selling the shares of its subsidiary located in India, which is, say, an unlisted company, and it is selling the shares at too low a price for whatever reason, right? It could be a distressed state, for instance. There, 50CA could step in, and therefore, in computing the capital gains in the hands of the non-resident, it is possible that the gains may have to be computed with reference to a fair market value, the fair share price of those shares, rather than the actual share price of those shares, which could be a lot lesser than FMB if that's the case. So that was a quick snapshot or a quick recap of the capital gain provisions. But now let's look into what the treaties, how do treaties tinker with the capital gain taxation rights between source state and resident state. So there are two states whenever we are talking in the context of treaties. Resident state is a state where the person earning the income is a tax resident of. Source state is a state which is the source of the income. More often than not, there's a state where the asset is perhaps located, right? I'm using the word perhaps because you would see there might be some tweaking to that understanding as well. So let's first look at what do most of the treaties talk about when they talk about taxation of capital gains. What I have done here is I'm usually referring to the UN model. At a few places where there's a variation in the OECD model, I'll highlight that. But the reason I have naturally stuck to UN model is because India, more often than not, desires or tries to conclude its treaties around UN model. Now, paragraph 1 of Article 13. Article 13 is the article in which more often than not you will find the capital gain provisions in most of the treaties. Paragraph 1 deals with taxation of capital gain when the asset being sold is an immovable property. We will see shortly that paragraph 4 is also around immovable property, but paragraph 1 applies when the asset being sold is the immovable property itself. We'll talk about paragraph 4 in a minute. So when the asset which is being sold is an immovable property, then the capital gain resulting from that sale will be taxable in the country where the immovable property is located. I repeat, let's read what it says. It says gains derived by a resident of a contracting state from alienation of immovable property situated in the other contracting state may be taxed in that other state, which is that other state where the immovable is located. Now, mind you, I often get this question that, Gaurav, when you are saying may be taxed in the other state, are we saying that the resident state cannot tax it? No, not at all. In fact, that was an interpretation which was made long time back in one decision, but after that a notification from CBDT came and it set the record straight. May be taxed does not mean shall only be taxed. The two expressions are clearly different, and you would find that shall only be taxed is an expression which is used in certain clauses, right? So where that expression is intended, that outcome is intended, that expression is something that you will find in the treaty clauses, and we will talk about that expression in a few paragraphs down the line in today's session. But otherwise, may be taxed means that particular country has been allowed the taxing right, does not mean to the exclusion of the resident state. Very recently, even the French Supreme Court came to the same conclusion. But fundamentally, what I'm saying is, in my example, imagine there's a Singaporean tax resident who holds an immovable property in India, and for the sake of convenience, let's assume that's an NRI, so that it's not a FEMA contravention. So here, when the Singaporean tax resident sells the property located in India, the immovable property located in India, the fact is that he's a Singaporean tax resident, and yet the state of India, that is India, will be allowed to tax the gains on sale of that immovable property. Why? Because the property is located in India. If Singapore wants to tax this gain, it's free to, subject to its domestic tax law. Now, paragraph 4 also talks about gains which are fundamentally arising from immovable property transfer. But this time, what you're selling is not the property itself. What you have done is you have house of property inside a company, and now what you're selling are the shares of that company, right? So this is something that we have seen in past also. This was a structure which was used long back to try avoid paying or reduce, or to try paying a reduced stamp duty value loophole, which has been plugged in most of the states, plus of course in the domestic tax law. So the treaties have also done this. So what essentially the treaties say is that if these shares of a company are being sold, and that company is deriving its value principally from an immovable properties which is located in India, then these capital gain on sale of the shares of that company will be taxable in India. India can tax it. Mind you, at no point does it matter where the company is located, of which state is the country located, a resident of. Let's read paragraph 4 here. Gains from alienation of shares of capital stock of a company, or similarly, interest of a partnership, trust estate, any other entity. But what's the common point? Property of that entity consists directly or indirectly, but principally means more than 50%, of immovable property situated in a contracting state. Then that gain may be taxed in that contracting state. So that's the important point, right? So just by locating the immovable in a company, you cannot act smart and say that now what I'm selling is not an immovable property, but the shares of a company, and therefore I will not pay tax in India. You will, if the immovable is located in India. The fact that you're selling the shares and not the immovable makes not much difference. Effectively, you are selling the immovable. If the value of the company, of this entity, is principally more than 50% derived from this immovable property, isn't it? Now, there are some exceptions which are carved out. There are some carves out in UN model, some carve outs are not there in UN model. So let's talk about those exceptions. It is possible that a company may be engaged in the business which itself is management of that immovable property, and the property is that property, the one that we're talking about, the one which is sold, is the one which is used in this business activity. What can be a business? What kind of a business can it be? Let's take an example. A company which manages malls, a company which manages office complexes, right? Now, this kind of a company here is, this company is not holding the immovable property to act smart about not paying taxes when the property is sold. No, it's genuinely using that property for carrying on a particular business. And here, since the business is management of the property itself, it's not that any business which is owning an immovable property and using it for its own office. No. The business is the management of immovable property itself, such as management of a mall. Here, it's an exception. If that's the case, then this provision will not apply. Then the capital gain may not necessarily be taxable in India. Now, we will talk about this clause in a little while again, but now we move to a clause which is basically property, movable property, which is owned by a PE. And in my example now, imagine the PE is located in India. If the PE is located in India, when I'm saying PE, I naturally mean the assessee is a foreign company, right? Or basically a non-resident, which is carrying on business in India through one or other kind of permanent establishment. And the permanent establishment is the one which owns this movable property. Now, if the permanent establishment sells the movable property, the fact that the PE owns this property, the PE is located in India, the fact that this movable property sale actually results into a capital gain, not a business income, that will trigger a paragraph 2 application, and this gain will be taxable in India, right? Now, mind you, it has been explained in treaties in their mutual convention that when some of the movable property is being sold, then this paragraph will apply. What if the entire permanent establishment is sold? Now, how could that be? When is an entire permanent establishment sold? Imagine a scenario where a company has an Indian branch, but then it decides that it will probably do a slump sale of the entire business of the branch to another company, right? Now here, when the entire PE is sold, the capital gain tax incidence will remain same. That is, whatever were the assets which were owned by this PE, when they are sold by the foreign company, which was the head office of this permanent establishment, to a buyer, maybe located in India, maybe an Indian buyer, then also the fact that it's not just one asset which is sold, but the entire PE which is sold makes no difference. This gain will also be taxable in India. Paragraph 3, something which we seldom see in real life getting applicable, is what happens when there is a sale of a ship or an aircraft which is operating in international traffic. The taxation of ships and aircraft which are operating in international traffic is an area which could get very messy, but thankfully, it's not, because standard principles apply world over. Whether it is about the taxation of the income from operation of these ships or aircraft, or it is taxation of gain from sale of these ships or aircrafts which are operated in international traffic. And these standard principles are that don't get into the sourced state taxability. That is going to be headache because they're operating in international traffic. Which state is source state? They could be operating in the territorial water of hundreds of countries. So let's not make a mess out of it. Instead, only allow the resident state to be the taxing right owner over these kinds of income, and that's what we see in our, most of the treaties. Sometimes they use the word, they try to determine the resident with reference to poem rules, or sometimes they simply say that wherever the contracting state is tax resident. So here what you see is an expression which says gains that an enterprise of a contracting state, the one which is operating the ships and aircraft, right? So enterprise of a contracting state means enterprise which is a tax resident of a contracting state, right? That enterprise, where will it be taxable? Look at the last line. It says it shall be taxable only in that state, the state where it is taxable. And now we come to the part which is perhaps the most relevant whenever we are talking about, or whenever we are dealing with taxation of capital gains. Why it is the most relevant is because it deals with taxation of capital gains on sale of shares. And this time, these are not shares which are deriving their value principally from immovable. No, imagine any client of yours which has a certain which has a share capital, and there's an investor which wants to buy that capital, a part of it maybe, and some part of the capital is presently held by a non-resident anyway. Maybe it's a parent company, right? Then when the shares of an Indian company are sold by a non-resident, maybe to another non-resident, right? So this is an NR to NR transfer. It could also be an NR to R transfer. Both are permitted. But the question is, the seller is non-resident. Will he be taxable in the source state? In our example, maybe India. The answer will depend upon application of paragraph 5. Let's read paragraph 5. It says gains other than those referred to in paragraph 4. Paragraph 4 was the one where the company is deriving its value principally from immovable property. So leave out those kinds of companies. Otherwise, gains derived by a resident of a contracting state, who's this person? The share owner. In our example, he's a non-resident. From alienation of shares of a company which is a resident of the other contracting state. In my example, this company is a resident of India. May be taxed in that other state, India, right? But when? if the alienator, if the seller, if the transferor at any time during the 12 months period preceding such alienation held directly or indirectly at least a certain percentage of the capital of the company, and that percentage is to be negotiated between countries to countries. Usually we find that it is 10% in a lot of treaties. So fundamentally, what does this provision say? Let's look at this provision, try to figure out what does it mean. What this provision is essentially trying to say is that we will tax the income of a transferor who's a non-resident in India if he's selling the shares of an Indian company. But there's a condition. If we start going around taxing even small shareholders, it will become a headache. So let's give a minority protection. Any person who's holding less than an X percentage, say 10%, most of the treaties, as I mentioned, about 10% threshold, leave those out. The small shareholders, even if they're selling the shares of an Indian company, we understand that as per Section 9, those gains are taxable in India. But in the treaty, we are giving them a minority protection. They're small shareholders. They are selling shares of an asset which is situated in India, because the shares of an Indian company are situated in India. Share certificates, no shares, right? So because they are holding less than 10% shares, let it be, let them go. We won't tax them. But if they are holding more than 10% shares, then the entire capital gains will be taxable in India. It's possible that they may be selling only a part of their shareholding. So to give you an example, where a shareholder owns 15% of an Indian company share, but he is transferring only, say, 4% of his shares, right? Which is much less than the 10% threshold. You don't have to apply the 10% threshold to the percentage of shares getting transferred. No, you have to apply this 10% threshold to the total shareholding of that share, right? And also, just that somebody smart is trying to bring down that ratio, just because before the share transfer, Cholbena, that will not work either. For that, a minimum 12-month threshold is given. That is, from the date of transfer, on the date on which these shares are getting sold, measure the last 12 months. And in the last 12 months, what was the maximum shareholding of this shareholder who's now selling the shares? He may now have less than 10% shares, but if in the last 12 months, if this shareholder's shareholding was more than 10% in this Indian entity, then whatever be the percentage of the shares that he holds now, whatever be the percentage of the shares that he's selling now, if his shareholding in the last 12 months was more than 10%, then the entire capital gains will be taxable in India, right? So this is something which is in effect a provision for taxation of shares, which contains a minority protection on one hand, and at the same time, some kind of an anti-abuse clause by having a 12-month threshold. Mind you, this clause is present only in the UN Convention. It's not there in the OECD Convention, which means in those treaties which are fashioned after OECD Convention, right? And you won't find a lot of them in India, but those treaties which are fashioned after OECD Convention, there, India does not get taxing right for capital gains in respect of such kinds of companies, right? Companies which are not deriving their value principally from immovable property, India does not get any taxing right. Instead, those capital gains are covered under this residual clause. What is this residual clause? Where none of the earlier clauses apply. That is, we are not talking about immovable property. We are not talking about shares of a company which is deriving its value principally from immovable property. We are not talking about PE property. We are not talking about ships and aircraft. We are not talking about ordinary shares. Then any other property, if that is being sold here, the exclusive taxing rights are given only to the resident state. So let's take an example for instance. Assume what has been sold is a debenture. Now, debenture is not share. It's not covered in any of the paragraphs that we have so far discussed. And if these debentures are sold by a non-resident, right, then the capital gain arising from the sale of those debentures, it's a property which is not referred to in paragraph 1, 2, 3, 4, or 5. Therefore, here that capital gain will be taxable only in the resident state. It uses the word only. I've capitalized it, right? Second sentence, second last word, only. That means India will have no taxing right, in spite of the fact that the debenture is located in India because it's a debenture of an Indian company. Yet the treaty protection is available to non-residents. Now, I've given you an example of debentures, and you must be thinking, I can probably stretch it to so many other kinds of assets. And the answer is, yeah, absolutely you can. And here I have given you some case laws on which you can also rely when you're talking about bonds, debentures, units, index futures, options, stock options, right? So you can rely upon them when you are selling any of those assets. Here are the case laws which will help you to take a benefit of the residual clause, where that residual clause is present in the treaty, which you have to refer to, because capital gain clause of treaties differ from treaties to treaties significantly. Now, mind you, another kind of asset that I want to highlight here is an intangible. Well, intangibles are also capital assets, right? Now, they are not covered in any of those assets unless we try to think that, intangible, which is a movable asset, which is a property of a P, leave out those kind of scenarios. But otherwise, intangibles are not covered in any of those clauses. And where, therefore, an intangible is sold and the treaty contains a capital gain clause which has a residual clause which gives exclusive taxing rights only to the resident state, probably you can rely upon this provision because there's no other provision to worry about. So here is a table which has summarized what we have studied just now, the taxation or taxing rights of the two states in respect of various kinds of assets. We'll pause here, and now we will quickly look at some of the good trading partners that we have and their treaties with us, with India, and what are the kinds of capital gain clauses that they contain. It's easy to talk about what the OECD convention says, what the UN convention says, but when we actually start looking at treaty, we find 3-4 different kinds of variants of capital gain clauses. So let's look at, for instance, if you look at India-UK treaty or India-US treaty, from a capital gain perspective, there's no point looking at the treaty for the reason it simply says that do whatever is written in your domestic tax. It gives no benefit, no reallocation of taxing right between resident state and source state. No, all it says is whatever is written in your respective domestic tax law, please do it. Therefore, if there's a US investor who owns maybe only 3% shares in an Indian company, less than 10%, right? And that company does not derive any value from the immovables located in India, just because Section 9 says that if the assets are located in India, if the assets are situated in India, then the capital gains will be deemed to accrue or arise in India. It means that the capital gains on transfer of those shares will be taxable in India, because simply there is no treaty protection if you look at India-UK treaty or India-US treaty. Some treaties, such as Netherlands treaties, they go even beyond what is something that we have studied just now. So what we studied was that if the shareholder who's selling the shares in an Indian company, he owns more than 10%, he's a comparatively bigger shareholder, right? Not a small shareholder. Then and then alone, we will allow the source state, India in this case, a right to tax it. Here, Netherlands treaty creates one more condition on top of it. What it says is that, yeah, India can tax it, but there's a condition. And what's that condition? If the transfer is taking place to an Indian resident, right? So the Netherlands treaty actually doesn't just give you the benefit which is given in the UN convention, it goes beyond it. So if a non-resident, a Dutch owner of an Indian company, or more than 10% shares of an Indian company, if he's selling the shares of this Indian company, the fact that he is a more than 10% owner is not sufficient to allow India to tax that capital gain. No, sir. On top of it, he has to be transferring the shares to an Indian resident, then and then alone India can tax it. If the Dutch resident is selling those shares to another person, then no thank you, but there will not be any taxing rights with India in respect of these capital gains. Also, there is a further relaxation which is given, which is that even if the shares are transferred to an Indian resident, still the capital gain tax cannot be applied by India if this is essentially a corporate reorganization. And in order to see whether or not it's a corporate reorganization, there's one more added condition which is given there, that the buyer and seller, they have to be some kind of related parties, right? They have to own at least 10% in the capital of the other. The buyer owns 10% of the capital of the seller, or seller owns 10% of the capital of the buyer, and buyer is selling to the seller is selling to the buyer these shares of this Indian company. The buyer so far holds more than 10%, and the seller is of course selling it to an Indian buyer who's an Indian tax resident. Let's look at the Swedish treaty also. It is a very interesting treaty. Now, before we get into the direction of Swedish treaty, when we are talking about taxation of capital gain, and if I'll not talk about Mauritius, that will be injustice, right? After all, India-Mauritius treaty and its capital gain clause has been infamous. It has given rise to so many controversies, including perhaps the biggest tax controversy on international taxation, maybe in the world, and I'm talking about Vodafone, right? And so many of them still keep spilling over all the time. Essentially, the issue with the India-Mauritius Treaty, the old treaty, was that there was no capital gain taxation clause for shares per se, which means India never got any taxing right, in spite of the fact that the shares of an Indian company are being sold by a Mauritius resident who holds maybe more than 10%. Hell, he holds maybe 100% of the capital of the Mauritius entity, of the Indian entity. Second problem was, because of this, the residual clause will kick in. And the residual clause says that even if the shares of, whichever be the asset that you're selling, that could even be the shares of an Indian company, the taxing rights are there only with the state of residence. In case of India Mauritius, more often than not, the state of residence was Mauritius, which means India can't tax it, which is also okay to some extent. There are some other treaties also where we allow the resident state to tax it. India doesn't tax it, but the problem was, the kicker was, Mauritius was not taxing it either. Mauritius never wanted to tax the capital gains from sale of Indian shares by Mauritian resident. That was the whole point about Mauritius-India Treaty, which is the reason why Mauritius was at a point of time, and for the longest stretch of time, the biggest FDI contributor to India, in spite of the fact that, let's face it, it's not an economic superpower. The problem was that while India could not tax it, Mauritius wasn't taxing it either. And that is what was pinching us. That is what was pinching the Indian tax authorities. After all, even Lord Buddha said that a lot of people are not really sad from their sorrows. They are sad because others are happy, right? And that is what was going on here. It's not the problem that we are unable to tax it, just that nothing is getting taxed. This is a case of classic double non-taxation. And that was never the intent of entering into treaties. At least that was the principle. India-Swedish treaty creates a loophole plug for that. It does not contain that loophole. It says, okay, fine. In the residual clause, we will allow only the alienator state to tax certain kinds of incomes, and these resident state to tax certain kind of incomes. Source state will not be allowed to tax it. But the condition is that the resident state will then actually exercise that right to tax it. As it won't be that source state cannot tax it, the resident state can tax it, but in the domestic tax law of the resident state, there's no tax on that case, because then there's a double non-taxation. In that case, we are not taking away the taxing right of the source state. So let's read what paragraph 5 says. It says, capital gain on sale of shares will be taxable only in the state of residence, right? So it gives exclusive taxing right to the resident state. It does not give any taxing rights to the source state, but there's a condition. It says, provided that such resident is actually subjected to tax thereon on those gains in that resident state. Because if the resident is not actually subjected to tax on those capital gains in the resident state, then there's no fun in denying even the source state any right to tax it, because then you are encouraging double non-taxation. So Swedish treaty already has plugged that loophole long back. Also, Swedish treaty has a very unique clause, and I'm just bringing your attention. It's not that we will use it very often, but we have seen recently some instances of a few people who have preferred to leave India because they did not want to pay something which they owed to India. So they flew away to some Caribbean nations or to Antigua or to other countries, so in some cases UK and whatnot. This is also something which is observed internationally in the context of taxes too. Let me give you an example actually. Facebook had a co-founder, and that co-founder, his name was Ejirado Severin. He was a 30-year-old guy, right? And he, in 2011, when he was selling his shareholding in Facebook, he would have been compelled to pay tax at the rate of 40% on that income. 40% of his income would have been given away as US taxes. And that was a big amount of money, approximately $700 million. This is the amount of tax, not the amount of income, the amount of tax. So what did he do? In January 2011, he applied that I want to surrender my US citizenship. In September 2011, he actually surrendered his US citizenship. Now, Mr. Severin maintains that he did not do it to save taxes, but There are good number of articles. US congressmen, they alleged that this is a case where a person is just simply letting go of his US citizenship because he doesn't want to pay taxes in US, something which are otherwise rightfully the claim of US tax rules. So much so, it became such an issue that couple of the senators, Schumer and Casey, they even proposed a new law which was called the Expatriate Act. So it's patriot is essentially here, or rather expatriate is a fantastic abbreviation. It's an acronym. It stands for expatriation prevention by abolishing tax-related incentives for offshore tenancy. So essentially, what they were saying that we want to prevent expatriation, movement of people from US to abroad, by abolishing the incentives, the tax-related incentive by shifting abroad. Okay? So that was the proposal that they came up with. The whole point is, it's possible that if you are earning such a huge amount of income that you feel that I'll have to pay such a big amount of tax in my country, why would I just completely leave this country? It's such a high tax, and I go to a country which does not probably levy tax on capital gains, and there are a good number of countries which don't levy tax on capital gains. In fact, if you think about it, classically, even US never wanted to tax capital gains in more often than not scenario, although now we are seeing it on the other end of spectrum, where US is saying that its capital gain taxes rate could go as high as, in some cases, as per Mr. Biden's plan, to 43.27%, if I recall correctly, right? So here in Sweden's treaty, they have already created a plug for that possible loophole where in my example, where a Swedish tax resident, if he wants to quit his country, or if he has quit his country, if he has already quit his country, and after that earned a capital gain, then still he will be taxable in Sweden. And this is a unique clause because here taxing right is given to a country which is neither the resident state right now nor the source state right now. So let's read what paragraph 6 says. Capital gain on sale of property derived by an individual being a resident of a contracting state, any contracting state, and Swedish, this contracting state, who becomes resident of other contracting state is taxed in the first contracting state, Sweden. Right? If alienation is made within 4 years from ceasing as a resident of the first contracting state, which means a Swedish tax resident moves to India. If the tax gain is taxable in Sweden, in principle, then even if he has shifted to India for next 4 years, he will continue to be liable in respect of this capital gain in Sweden for this particular kind of a gain. So these are some of the interesting clauses that we see. A few times I get this question, what if there's no capital gain tax clause? Well, frankly, almost all the good treaties have capital gain tax clause, right? Some of them, theoretically, if they don't have a capital gain clause, I can say, look for the other income clause. And now if you might ask that, what if there is a treaty which has neither a capital gain clause nor an other income clause? There's actually only one treaty which has this example. And that example is India-Libya treaty. And even there, we don't achieve something so unique by having not a capital gain clause and not another income clause either, because in that case, simply the treaty does not deal with this matter, which means whatever the domestic tax law does, it can continue doing, which means if that gain is taxable in India as per the domestic tax law, it will continue to be taxable in India in domestic tax law, in spite of the absence of the capital gain tax clause and the other income clause in this particular treaty. Again, so since we touched upon Mauritius, let's look quickly at what is the status of the Mauritius treaty now, right? Because you might still come across a lot of cases in which Mauritian companies or Singaporean companies which hold the shares in an Indian company are now selling those shares. So what's the status right now? And the answer to that is the Mauritius treaty as well as the Singaporean treaty have been amended. Both of them contain a grandfathering clause for those shares which were acquired prior to 1st April 2017. When I'm saying prior to 1st April 2017, that means old acquisitions. If those shares are sold even today, then the old clauses of the Mauritian treaty and the Singaporean treaty will continue to apply, which means India will not have any taxing right to it. Only the resident state will have taxing rights about it, which in this example of mine is either Mauritius or Singapore, as the case may be. Again, I repeat, this is applicable only when those shares are sold which were acquired prior to 1st April 2017. But after 1st April 2017, the taxing rights are allowed even to the source state. In this case, my example, India. And in order to ensure that Jor ka jhatka dheere se lage, for first 2 years, that is, where the shares are acquired after 1st April 2017, but sold before 31st March 2019. They are acquired and sold within 2 years. There, both these treaties contain a clause that fine whatever is the capital gain tax which is otherwise applicable as per the domestic tax law of India. The treaty says only half of it will be payable. So 50% discount given by the treaty, subject to the satisfaction of the limitation of benefit clause given in each of these two treaties. The Mauritius Treaty says that if a Mauritian entity is a shell company, then this benefit will not be given. Which benefit? The 50% discount. Right? The grandfathering benefit will still be available, mind you, unless somebody can invoke other arguments which I'm not getting into. Also, if there is a Mauritian entity and it is spending and it has spent more than 27 lakh rupees, Indian rupees equivalent, 12 months before the sale of those shares, it will be deemed that it's not a shell company. And therefore, by spending 27 lakh rupees in Mauritius on operations of this Mauritian entity, it will be able to use this 50% benefit. But now this 50% benefit is a thing of past, because we are talking only about financial year 17-18 and 18-19, and by now we are sitting in 2021, or rather moving on to 21-22. Singaporean treaty also has similar provisions and similar LOB clauses, except that in LOB clauses the limits are more. But again, not talking about that because that all is in the context of the 50% benefit, not really. In Singapore treaty, there's one more condition. Even for the grandfathering clause, I repeat, even for benefiting from the grandfathering clause, that is, even if you want to take complete exemption for the shares which were acquired prior to 1st of April 2017, you still need to satisfy the LOB clause of the Singaporean treaty. This is a distinction between Mauritius treaty vis-a-vis Singapore treaty. This was a quick snapshot of how the treaty provisions deal with capital gain taxes. I will now, and this was the thrust of my discussion today. I will now quickly take you through some of the special provisions pertaining to capital gain taxes in the Income Tax Act. For instance, if any of your clients are offshore funds, then you can tell them that for LTCG, or you would find that they'll probably be aware of it, LTCG on mutual fund units will also be taxable at 10% without indexation. But the benefit of 115 AD is that the first provision to Section 48, which is not otherwise available to non-residents in normal scenarios, is available here in the context of listed units. Right? Similarly, for FIIs, there's a preferential regime that FIIs are foreign companies after all, isn't it? And yet their income from these securities will be taxable only at 20%, which is nothing too surprising. Their income is after all going to be interest on dividend, which is also anyway even in the domestic tax law taxable at 20%. But the good part is STCGs are taxable at lower rate, 15% or 30%, and LTCG again gets an advantage that it is taxable at 10%. Now this is important. Any of your clients which are NRIs, non-resident Indian, and Prasad sir has already covered in detail that when you are looking at NRI status, you have to actually look at status under FEMA. And in FEMA, there is a particular definition of who's an NRI, who has a PRI, who is a PIO. I'm not taking you through those definitions right now, but fundamentally speaking, if you are dealing with NRIs, then the good part is even NRIs can benefit from the first provision to Section 48, the TTBR TTSR adjustment, if they opt for 115E. That is, their LTCG will be taxed at the rate of 10%, but otherwise, when you are getting taxed at the rate of 10%, the normal provisions of the Act do not allow you to take that exchange rate adjustment, but 115E allows NRIs to take that benefit. And this benefit is in the context of shares and debentures of Indian companies, etc. Another benefit which is there for NRIs is that just like in the case of 54F, which is a capital gain exemption provision, 115F exists in case of these kinds of specified assets, that if you have earned capital gains, long-term capital gains from selling foreign exchange assets, that is shares or debentures of an Indian company which were purchased in foreign exchange, and then if you are planning to reinvest, then as long as you are ready for a lock-in period of 3 years for that reinvestment, you will not be subjected to any tax proportionate to the value of the consideration that you have reinvested. If you have reinvested the entire 100% of the consideration received, the entire 100% of the capital gain will be exempt in the hands of the NRI. There are certain exemptions which are contained in section 47. Certain transfers are not treated as transfers for the purpose of applying capital gains. And section 47 gives several relaxations, including foreign amalgamation, foreign demergers, transfer of GDRs, transfer of masala bonds, rupee denominated bonds. So, these are some of the benefits which you are probably already aware of or are specific to very specific to facts. So I'm not discussing them in detail. Even the section 54 series is pretty much very well available to non-residents. So you can keep that in mind too. And with that, I'm inching towards the benefits which are given to non-residents and foreign companies under section 10. It should not take more than 5 minutes, and then perhaps I'll take your questions. Firstly, a very specific provision which was introduced somewhat recently, that if non-residents want to deal in non-deliverable forward contracts on an offshore banking IFSC unit, which is located, say, in Gift City, right? That's the point of IFSC. That's one of the first IFSC in India. Then that income from these transfers will be exempt in the hands of the non-residents. Exemption for NRE interest has already been discussed in the first part of today's session. Similarly, a few other such exemptions are already discussed or are highly fact specific. So I've just left them for your reading, but are very, very fact specific. You will not come across them on a day-to-day basis. This is an important exemption, the one that we're talking about now, section 10(6)(6). It is called a short stay exemption. Nothing to do with capital gains, completely different discussion. We already know that salary income of a non-resident is taxable in India if he has rendered services in India when he earned those salaries, which means if a non-resident, let's assume COVID goes away, let's pray for it as well, and a non-resident now lands up in India, and he is present in India for, say, 2 months, right? And for those 2 months, he's not on leave. He continues to carry on his services remotely. And mind you, his employer may have sent him to India because he wants to probably, do a recce of the Indian market, meet the Indian customers, or the whole point of coming to India may have no relevance from an employer perspective. It's possible that the employee wants to visit India. So he told his employer that I want to take a working vacation. It's a new concept where the employee tells to the employer that, look, I will be available, I will work, but I will, since I am remotely operational, why would I work from India? I just want to explore the mystic country, probably discover yoga, learn a little bit of siddhis, watch a few sadhus, but I will keep on working on whatever your project is. It has nothing to do with India, but I'll do it. The fact that this employee is present in India for those 2 months when he's rendering those services is sufficient to trigger taxing right with India because section 9 says so. But for those people who have come to India for a brief period, for a roughly shorter period, and salaries are not claimed as a deduction in India, that is, there's no base erosion happening in India either, there's an exemption provision, and this is called a short stay exemption. So what it fundamentally says is that where an individual has come to India and he's rendering services in India, he's not an Indian citizen, mind you, right? He has come to India, he's rendering services in India for which he's earning salary income. Then while that salary income would have probably been taxable in India, but we are letting it be exempt, provided A, his presence in India in that year is less than 90 days, that he's come to India only for, say, less than 3 months. Second, his employer is not carrying on any business, etc. in India and is not claiming the deduction for that salary payment against that Indian business's income. As long as these conditions are satisfied, fine. This person has come to India, Atithi, they will have a visit, have a good deal of time, but we will not tax you. Mind you, treaties also contain short stay exemption. But first of all, and that short stay exemption is actually beneficial, right? It is available for longer duration presences in India, right? At times it goes beyond 90 days as well. But the point is, what if that individual is unable to furnish a TRC? Then the treaty benefit cannot be availed, but this benefit in the domestic law can still be availed. And that brings me to the last provision that I'm discussing you today. And this is a comparatively new provision, which essentially says that if a non-resident has earned certain income, which has already been subjected to equalization levy, then that will not be doubly taxed, in the sense it will not be taxed under the income tax as well. The background essentially is that, firstly, fundamentally speaking, there should not be any double taxation anyway. This BEPS project, Action Plan 1, when it mentioned equalization levy as one of the possible ways of collecting taxes. The fundamental idea was that because the taxes cannot be collected from digitalized businesses by application of normal provisions of domestic tax law, that's the reason why one will opt for equalization levy. But if those entities will be the foreign entities, the non-resident entities will be taxed by way of equalization levy as well as income tax, it will double the whammy. Should not happen, right? And that's what section 10 subsection 50 does. What it does is that if a non-resident has already been taxed under the equal provision, equalization levy provisions, then that same income will not be taxed under the act because section 10 exempts it. And particularly it goes on to say that, look, we know that you are kicked up about this exemption, but don't be oversmart. Don't think that instead of paying 10% tax on royalty and FTS income, let's shift to equalization levy, because there we have to pay tax only at the rate of 2% if we are an e-commerce supply or service transaction, or topmost 6%, even if it is an online advertising or digital marketing transaction. Still a saving, not at all. If the income qualifies as royalty and FTS, then this whole provision will not apply, because royalty and FTS will continue to be taxable under the act and will not be taxable under equalization levy. So this is how the scales have been balanced. The background essentially also is that in one of the cases, the revenue actually had to furnish an affidavit to the High Court that, look, we don't want to tax this entity at both the fronts, because here MasterCard, it was worried that, look, right now you are saying that we have a P in India, but later on you will also levy equalization levy on it. This is double whammy. What if you have already deposited equalization levy? Will you refund it to us or not? So there the revenue said, hold on, we will tax you at one place, and if you have paid taxes under the other provisions, we'll refund it. Right? That was an affidavit that was given by the revenue to the High Court, and that's the background of this explanation too. I will pause at this stage and take up your questions, if any.
Thank you, sir.
Just to give you some relief, I will read out the question louder,
right,
so that you can just answer it. And I'm starting from the questions raised to you. The first one is from Kodandapani JV.
Right.
Sir, when a transfer of an asset by a non-resident results in a capital loss, is TDS under 195 still required? In other words, is the tax withholdings to be applied on gains or sale proceeds?
Right.
Can he be treated as a defaulter under 201?
Perfect.
You covered this, but still.
Perfect. Very good question. If there is a tax loss, then section 195 cannot get triggered per se. There has to be a positive income to apply tax on it. And therefore, my answer, straightforward answer will be that if the seller has actually incurred a loss, and as a buyer, you are convinced about that calculation, you have done your due diligence, you have collected the proof that the cost base which is being showed by the buyer, by the seller to you, is a correct tax base. The basic legal provisions are that because there's a loss, there's no question of withholding tax. As I mentioned previously, that when these are high value transactions, you would often find that your advisors will tell you that, look, it's a high value transaction. Whether this loss will be accepted by the tax authorities or not, this is a bit contingent, and get it okayed by the tax authorities by invoking section 197. That is an abundant caution. From a legal perspective, my answer is, if there's a capital loss, withholding tax provisions will not apply.
Yeah, I think this question more came from the point of view of practical nature of our work. People just finish off everything and then come to chartered accountant. So if we have a clause like this, we can always try to work around.
Yes.
Thank you. I'm going to next question. What is the TDS rate on short-term capital gain arising on sale of unlisted securities of an Indian company by a non-resident to foreign company?
10%.
10%. Thank you. Yeah. A Singapore NRI sells property in India. TDS is deducted at 20.8% on income by Indian buyer under 195.
Right.
Can AO invoke that as per treaty should be taxed in India?
The fact that the buyer has already deducted taxes at the rate of 20.8%, and assuming there's no controversy around the base on which this tax should be levied, I doubt the AO has a lot of leeway to tax it any further, unless I'm misunderstanding the question.
Yeah, in fact, I'm also believing that the 20.8% is on actual gain only. And
Yeah.
as you have been saying, if it is on verified calculated gain, then
Yes.
there should not be a major problem.
I agree. I agree.
I go to next question.
Sure.
If the shares are held by a foreign citizen,
Right.
Hong Kong is the word written, in
Right.
Indian company,
Right.
and if he sells the share to a citizen of another country, say Japan, for
Right.
higher value,
Right.
whether the capital gains are taxable in the hands of the original shareholder in
Right.
India.
Absolutely. So if the Hong Kong shareholder has sold the shares at a profit, by higher value, I mean, I understand what you mean to
It's a
say,
profit.
at a profit, then certainly, I'm obviously assuming that the Hong Kong shareholder owns more than the minimum threshold prescribed under the India-Hong Kong Treaty, that is 10%. As long as that is the case, the capital gain will be taxable in India because the shares are that of an Indian company. If the Hong Kong shareholder is a minority shareholder, then naturally the treaty benefit will be available.
Thank you. I'll just take anonymous attendees I'm avoiding because the next question is from Papaya. I'm just taking the questions. Will transfer of shares to non-resident beneficial owner on account of liquidation of foreign company having a subsidiary in India be taxable in the hands of non-resident? Section 46.
So yeah, I would say why not? The Section 46 does not have any countering provisions in the treaty. So my take is, if Section 46 is getting invoked, tax implications will follow. The fact that this is a transfer by virtue of liquidation should not make much of a difference.
The next question, sir, what was the stand of Cairn Energy versus the stand of IT department in creating a tax liability? What are the conflicts between taxation law versus protection under bilateral investment treaties?
It's a very, very good question. And really, even if I had 45 minutes, I would have still probably claimed that I'm short of time to answer this question in the truest manner. I have another video somewhere I have answered this question, or actually, addressed this issue in detail. But fundamentally speaking, the issue is again that of indirect transfer, right? The only thing which happened, which was unique in the case of Cairn vis-a-vis in the case of Vodafone, was that in case of Vodafone, the tax dispute went up to the Supreme Court, and then there was a retrospective amendment. In Cairn, before all that could happen, that is, things could travel as high as the Supreme Court or something, even before that, the investment protection treaties were invoked by Cairn, which is what was unique here. And the favorable award which Cairn has got so far is something which is under those investment protection treaties. It's not a tax award per se, right? That's point number one. Point number two, there are too many stories going around this thing. Which one is a right one? Which one is a wrong one? Which one is a fact? Which one is a fiction? We don't know. For instance, there have been stories that the Indian Finance Ministry has told the banks that take the money out of there, otherwise Cairn will use the convention to attach it and recover, because in the last arbitrator award that it has got, it has been awarded damages, and huge damages, right? There are also stories that Cairn is probably going to try and invoke the attachment of Air India's aeroplanes. Then there is a finance ministry's rebuttal that nothing like that is going on. On the contrary, at some stage, the finance ministry encouraged Cairn to go into Vivad Se Vishwas. There's now a talk that we will appeal against this arbitration award as well. But fundamentally speaking, gentlemen, the way I would answer this question is, this is also a question of indirect transfer, and the arbitral award is not a tax award, but instead an award under the investment protection agreement. But I would love to talk about in greater detail if you want to, and we can connect offline.
Your mail ID is visible on the screen.
Yeah, it's already there on this slide.
The next question is any impact of MLI on the capital gains in DTA? After this, we have 4 questions, sir.
Right. So I would say not a great deal of impact except 2. See, most of the treaties which India has already contains the indirect transfer right for India in the context of immovable properties, right? I repeat, immovable properties. Otherwise, offshore indirect transfers are not taxable in India in treaty context more often than not, unless the treaty does not, India treaties like a US treaty or a UK treaty with India, which says whatever the domestic law says, do it. But immovable property, more often than not, you will find India already has the taxing right where the immovable property has been transferred indirectly. So MLI has tried to do that. So that does not change the things a lot because India already has that taxing right in most of its treaties, even prior to MLI. Second thing, a very important thing which will now happen is the PPT clause, principal purpose test clause. Now, the point of principal purpose test is it contains no grandfathering. So right now, for instance, we were talking about certain grandfathering clauses which are there in the Singapore treaty. Right? I'm not talking about Mauritius because Mauritius treaty with India is not a covered tax agreement. It is not covered by the MLI. Mauritius said, thanks, but we don't want it. But what I'm saying is the PPT clause essentially says that if the principal purpose of a structure, arrangement, or a transaction is to avoid paying certain taxes which were otherwise perhaps intended to be paid even by the treaty, then you can't take advantage of a particular benefit given under the treaty. That benefit will not be given to you. And I've put it in a very laymannish term. We can talk about it in further threadbare detail, but this is the fundamental rule which is given in the PPT clause. Now, we already know that a lot of companies, a lot of corporate capital holding structure were structured in past, were created in past. And a lot of time, they were perhaps created with maybe an intention that whenever in future the owners of these Indian entities will exit from this Indian investment, they will probably be able to save those Indian capital gain taxes by virtue of these unique creative holding structures. But now, because of PPT, it may be so that even those old investments may now have to be justified. Those old investment holding structures may have to be justified. The fact that a lot of those investments are held through jurisdictions where there is no economic substance, which do not really add any economic or commercial value to that holding structure, that will have to be justified. And if that justification is not acceptable to an Indian tax officer, then perhaps the capital gain protection or exemption contained in those treaties will be denied by invoking the PPT clause. And mind you, this kind of an invocation is possible to some extent, not entirely, because to some extent it is available under GAR, although GAR also has some grandfather. But the point is, even if you leave aside the grandfathering protection, GAR has a lot of administrative checks and balances, such as the officer has to take a permission from his CIT to proceed, and finally from a GAR panel to actually apply GAR to a particular transaction. PPT has no such administrative checks and balances, at least at present. And therefore, if an Indian tax officer, if he feels that you are trying to benefit from a particular clause, the residual clause, which grants only the capital gain taxing right to the alienator state and not to the source state, he can deny that by saying that, look, I don't think you meet the PPT test. Otherwise, if you prove to me, why is it that you have come through this particular jurisdiction and actually it is not adding any value, any commercial value to the whole holding structure? And if you are unable to satisfy that to me, I will happily invoke the PPT clause. So I think this, gentlemen, is one of the most important implications of the MLI on the treaties in general and on the capital gain clause in particular. That's my answer.
Thanks, Guru. Taking the next question.
Please.
In case of transfer of shares of an Indian company happens between a non-resident to a non-resident,
right,
and the seller non-resident is not complying with the tax payment obligation,
right,
will there be any responsibility on the Indian company?
Very good question, actually. Well, two things. Number one, I don't think in a general scenario, there is any responsibility on an Indian company when there's a direct transfer. Mind you, if they're an offshore indirect transfer, the Indian company is required to report it by filing Form 49D and all those things if those conditions are met. But again, can the Indian company be saddled with the tax liability? I don't think that provision can be invoked unless, there was a 163 kind of a situation, which is not, to my mind, applicable in this case. Here, if at all this provision is to be invoked, it will be invoked vis-a-vis the buyer, and essentially that's what happened in the case of Vodafone. Vodafone was not the seller. Vodafone was not the one which earned the income. The entity which earned the income was Hutchison, right? Vodafone was the one which was paying them. So it was an NR to NR transfer, and because Hutchison messed up, in a sense, it messed up on its responsibility for deduction of tax. Vodafone messed up on its responsibility to deduct tax. The case law will be known for decades from now as the Vodafone case law and not the Hutchison case law. But to answer your question, the Indian entity of which the shares are getting transferred, I don't think it runs a risk of being saddled with this tax liability in normal circumstances.
Yeah, taking the next question. Sir, is TDS under 195 required in case of remittance of gift by a resident to non-resident, particularly in case of taxation of gifts in the hands of non-residents?
Good question. So section 9(1), if I recall the clause correctly, 9(1)(8), particularly now says, it was something which was a gray area earlier, but now it clearly says that where the non-resident has received a gift of money, even that income accrues or arises in India. So in this question, if it's a resident which is gifting to a non-resident, then because of section 9(1)(8), this gift can be said to have been or is deemed to have been accrued in India. And if it is so, then section 195 will get triggered. And I don't think a particular treaty protection can be claimed that because treaties don't deal with these kinds of extremely fictitious deeming fiction, such as the one which is there in 9(1)(8).
Thank you. Are you in a mood to answer more questions? How is the?
Sorry, come again, please, sir.
Will you be able to answer, because questions keep flowing?
I mean, so long as we are talking about taxes, I have all the energy in the world, sir.
Tax withholding in the cases of 50C and 56(2)(10), the obligations on the part of purchaser remitter.
Very good question. See, in case of 56(2)(10, really the point here is that, so let's look at this transaction, right? If I am a person who has acquired certain shares at too cheap a value, then the person who has acquired the shares at too cheap a value, he's the one who is giving the money, isn't it? So the person who's taking the, that person cannot apply TDS. So 56(2)(10 is something that we don't have to worry about a lot. 50C is something that worries me a lot. 50C worries me a lot, because the question is, what's the value of the gain on which we apply TDS? Should the person who's deducting the tax also take into account the fair market value or not? Well, more often than not, you will find that in third-party transactions, the person who's buying, he would believe that it is a fair market value. Because if it is not a fair market value, it will be a very strange kind of a situation where a buyer will acknowledge that I am getting it for something too cheap. Long story short, I think practically speaking, as long as you have a semblance of a valuation report which supports your valuation, you're adequately protected. But how this thing will shape up in future is something that we all are. I'm personally very interested in seeing how it will shape up in future. But from the present perspective, when you are deducting taxes, I think you can safely deduct tax on the actual value of the transaction without worrying too much about section 50C, as long as you have a valuation report to support the value of the transaction, a good valuation.
Just that last slide of your mail ID, because Anu Gupta wants your mail ID.
Sure.
Okay, so that is one thing. So which
easiest question to answer.
Yeah, easiest question. I'll just take one more question and stop it, because it's already 8:15.
Sure.
The gift is by resident mother to a non-resident son of rupees 10 lakhs.
Right.
whether the gift is exempted from gift tax, being a gift from relative.
Yes, it is. It is. Because if you look at it, Section 9 does not create any new law. What it does is, Section 9 refers to Section 2, subsection 24, definition of income, which contains this deeming provision, which in turn takes you to 56. And 56 contains an exemption for gifts between relatives, and mother and son are, of course, covered in that exemption. So long story short, in this case, no tax, no withholding taxes applicable.
Yeah. Last question before I hand it over to Chairman. Please clarify the taxation on interest income on foreign currency bonds and foreign currency loan to non-residents. Any lower rate of taxation as per Income Tax Act?
Good question. I think there are so many answers to these questions because there are so many provisions which create special beneficial lower tax rate, lower withholding tax rate, such as 194 LC, LD, LBC, etc. and all that. So it will depend upon case to case, but fundamentally speaking, what you'll find is that generally the withholding tax for interest is 20%, but there are a good number of instances where you can bring down this withholding tax rate to as low as 5%. There used to be certain exemptions, particularly for certain RDBs or masala bonds, rupee denominated bonds issued in past. So my take is, I can probably share with you if you reach out to me separately, instances which can be more relevant to your particular case or a general table perhaps, but it would differ from case to case. But the answer to your question is yes. There are several instances for which you can look at the provisions I was just now mentioning, that in those provisions, interest on ECBs, external commercial borrowing, or RDBs, that is masala bonds, enjoy a preferential or a lower withholding tax rate, lower TDS.
Thank you. I think I hand it over to Chairman because there are 25 questions, of which 24 at least looks important. So we can't continue the whole night. So thank you very much, Gaurav. It was excellent, Frank.
Thanks.
And please tell us how to get that energy so that it will help us.
Sorry?
Thanks.
How to get that energy?
Sir, I am one of those lucky ones who is working in that field which I love. So that is answer. I have been in love with taxation for 2 decades, and unlike a lot of other love affairs, this one is going strong. For past 2 decades.
Congratulations! I hope your wife is not listening to this.
This is public forum, so I would say that even that one is going pretty good.
I'm sorry, Chairman, please. All yours.
Yeah, thank you, sir. Gaurav sir and PVSS Prasad sir, really thank you so much for your time and efforts, and very well explained talk, and lucid presentation from both of you. As usual, PVSS sir, thanks, a very excellent presentation, and particularly international taxation, and which conducted by the HO. The same feedback now also, and the HO has conducted international taxation program in the last month. And there, both of you got excellent feedback. Based on that feedback, I requested PVSS sir to organize this program. So, thank you, sir, for designing this program and helping me out with the great speakers. And before I request Dayabai to give a closing remarks. And as a token of thanks, we request you to accept a certificate of appreciation from an Hyderabad branch. And looking forward to our continuous support for an Hyderabad branch and Hyderabad members, Gaurav sir. Anyhow, Prasad sir, there is no request because he's already doing the same thing from the last several years. And Satish, can you?
Yeah.
Prasad sir, I request you to kindly accept the certificate, virtual certificate of appreciation from the Hyderabad branch.
No, it's my pleasure, Master, and I congratulate you for an excellent event being conducted by you. It is for the benefit of one and all, and the other speakers have readily agreed, which will make this program very, very beneficial for the audience. And I congratulate you on this event. Thank you.
Thank you, sir. Thank you so much, sir. Thank you. Satish, Gaurav sir, Satish.
Yeah, please. 1 minute, sir.
Gaurav sir, once again, thanks a lot for accepting our invitation from Hyderabad branch. And
Is it visible, sir?
Yes. As a token of thanks, I request you to kindly accept a virtual certificate of appreciation from the Hyderabad branch, sir. for both the speakers. Thanks a lot from entire managing committee of Hyderabad branch and all the delegates. Thank you, sir. I request Central Council members, Dayana Sharma ji, for a closing remarks.
Thank you, Chairman. Immediate past Chairman Pankaj Bhai and Satish, thank you very much for giving me an opportunity. And
Daya sir, sorry I'm interrupting you. Not immediate past Chairman, is a permanent Chairman for the last several years. Sorry, please carry on.
Thank you. Yes, I'll rectify myself. More importantly, respected PVSS Prasad sir, thank you very much for always being available for the Hyderabad branch. It's your branch. And we are only continuing the legacy. That's the only thing which I can tell you. And more importantly, Gauraji, thank you very much for coming to Hyderabad and sharing your views. And what interesting it is, like, basis of taxation for NRI and capital gain exemption, which are the most sought after topics. Which are the most sought after topics in the day-to-day affair. And I think Hyderabad is also moving very fast on this particular aspect when we have non-residents and the capital gains. A lot of people are settled across the length and breadth of the world. And more importantly, previous Prasad sir, I think you should be coming and talking on the global minimum tax, which is going to be the future of this taxation, which is going to be, redefining a lot of things in the country level, including, I know, country like Dubai is actually getting into a lot of structured approach, which is the most exempted country in the world. And, the residential status is becoming one of the most crucial factors in times to come. And there are many ways where you talk about 182 days, less than 182 days, more than 182 days. Every country has a different year and days in which we need to calculate. And I got one very interesting case study when people talked about a person traveling across the length and breadth, staying on a different location where he is on a no man's land, I believe, because he is ensuring that he's not there for that number of days to be called as a resident in that particular country. So previous Prasad sir is laughing and he understands what I mean by it. So he is on the no man's land. He is owning the sky, I believe. So, but the fact is, the global minimum tax, which is going to be the future of a lot of things, and a lot of people are going to get opportunity in that area. And we are going to look into different aspects, and the simplification which is coming up, rather simplification ke saath multiplication which is coming in with regards to compliance, and you need to understand every law. So friends, I can only tell you, which Prasad sir also will agree. Now, chartered accountant is not for only filing an income tax return. Now, the income tax returns are going to be something different and very interesting. And you have to be an advisor knowing the world tax knowledge if you have to practice it well. And that is an opportunity which is there for India particularly, because a lot of things are happening at the country level and a lot of positivity which has been created in the global front, and a lot of such new opportunities are going to continue to come. And every time it is not that the large firms are going to get an opportunity to, understand the residential status of a non-resident who's an individual. Whereas if your profiling is going to develop in a qualitative manner, there is not much that can be done. And today that conversion value, it is not equivalent to 1 rupee, it is equivalent to 75. When you talk about anything, if it is $100, you can imagine what is the price which you are going to get, or $1,000, what is the value you are going to get. And people don't bother to spend when you get a right advice. So thank you very much for taking us through these two important topics, which is basically resident purpose ke liye. But I think time has come where the non-residents are also going to come into India, and a lot of such new things are happening. I just want to leave that seed of thinking on the global minimum tax, which Prasad sir is going to come and share with all of us in times to come. And it's going to be a big opportunity for chartered accountant, particularly in Hyderabad, which is having a lot of expats who is operating here, and a lot of Indian companies which are operating globally. I think people need people to service. It's not always that only larger firms or big firms are only going to survive. So let's get into the new area. Thank you very much. Thank you very much for sharing your views, sir. Look forward for enriching sessions more.
It's a very right topic which you are suggesting. I mean, the global minimum tax is the most in thing where US is really supporting that proposition, though it's not supporting the pillar 1 digital taxation. So the minimum tax is going to change the landscape horizon across the world. And we need to really look at it from the pillar 2 perspective of OECD. And definitely discussions are going to happen. We'll initiate that discussion at the Hyderabad branch level, and we'll escalate that. We'll definitely do that. And we'll involve other experts from the tax fraternity, and we'll also involve Gaurav and other friends, and we'll try to do our best in that.
Thank you, sir. Thank you very much. Thank you, Chairman.
Thank you, Daya sir. Thank you.
Thank you, Chairman, sir. Thank you, Daya, sir.
Thank you, everyone. Just a reminder for tomorrow's session, which is on deeming provisions in respect of non-residents with respect to indirect transfer, interest and royalty, and a fee for technical services. It is by CA KR Shekhar, Bangalore. And as you are all aware, the session starts at sharp 5, come what may. So request all of you to assemble by 4:55. Good night. Stay safe.
Thank you, Pankaj sir, for the announcement. It's my proud privilege to offer vote of thanks on behalf of Hyderabad branch for this wonderful session. CA PVS Prasad sir and CA Gaurav Singhal sir, we are pleased to hear your session, and I hope our members enriched their knowledge with your expertise and experience in the subject. Sir, the way you answer all the questions with practical examples, showing your passion, perfection, commitment to the profession and members. Thank you, sir. Once again, please accept our sincere thanks on behalf of Hyderabad branch and its members. We thank our Central Coast members, CA Dayana Sharma, for his closing remarks, and the Sikasa chairman of SIRC, CA Naresh Galli Garu, for his opening remarks. We thank Chairman Macharao Minvalli for choosing the right topic and selecting the best professional experienced professionals for today's lecture. We thank our Vice Chairman CA Deepak Ladda and immediate Past Chairman CA Pankaj Trivedi for their nice introduction of today's session speakers. Members, with this, we are signing off for today, and tomorrow evening 5 p.m. we will meet again. Once again, thank you.
Thank you, sir. Thank you, sir. Thank you, Gaurav ji.
Thank you, sir.
Thank you, Pankaj sir. Thank you.
Thank you.